One I couldn't get because it said retained earnings. So I don't think we've done that.
Okay. All right. Fair enough. Yes.
Two, I had like a double option. I had option three or option four because it said fixed deposit
Yes.
at Blonde Bank, but a fixed deposit can be less than 12 months or it can be more than 12 months.
True. That is a valid point. But if they
So
don't
it
give
was kind
you
of
an
more.
actual date attached to it, so if they don't tell you it's redeemable or it matures in or within 12 months, then I would assume it's long term. So yeah, I went with three for that one.
Okay.
That's my working. Land and buildings, equipment, investment, fixed deposit. So I did include that one because there wasn't anything mentioned in the question stating that it was short term.
Okay, so we just assumed that it was long term.
Yes. And then I think question three and four might have been a bit challenging. With those ones, did Unisa send any errata for this assignment?
I can check, but I don't think so because
You
I
don't
have
think
been
so?
checking that now. So
Okay.
they did
Well,
not.
just check it and see if there is anything because we can go through these first four questions just to highlight some of the workings because the workings in the first four questions are actually unrelated to the actual partnerships that we've been looking at so far, but it's mainly adjustments that you would have done in 1502. So nothing too hectic. Obviously, retained earnings, yes, isn't something that you've seen before, but I'll discuss what it is, and then you can actually see what the workings are going to be. So, and then the rest of the questions, I actually still need to complete them. Once I've done it, then I'll send it to you. You said the date was changed the 21st, is that right? The due date. Ooh, Cheryl, are you still there? I've lost your audio.
Yeah. Can you hear me now?
Okay, I can hear you, yes.
Okay. Yes, yes. So they did say the 21st.
All right, great. Yeah, so we still have this week. I'll probably get it done maybe later today or tomorrow, and then you'll have it. And then you can just review those answers before the 21st. Yeah, so I'll show you my workings for the first four questions. Obviously, covering most of the adjustments. These are questions that you could probably tackle. The only thing that, yes, you would need to know is what retained earnings is, but that we can look at. And this is obviously close corporations in terms of content, but if you remember what we said last week, we said CCs are actually quite simple because they're very similar to sole proprietors. So if you can do your normal sole proprietors, you can actually do CCs. The only thing different is obviously capital, the disclosure, but other than that, it's all almost identical. And even when you look at members and their relationship with the actual close corporation, they're separate and they're considered separate from the business because a close corporation is a separate legal entity. So all of that we'll cover in the actual notes. You've got slides on it, and the textbook also discusses that. So we can always go and we can revisit those things later on when we get to those chapters. For now, just to look at those four questions, let's put up the assignments.
Uh, Anthony, I'm actually just looking at my UNISA right now.
Yes.
And they said that the errata for question one, two, three, and four, which is bank, needs to be debit.
Okay, there we go.
The bank needs to be debit, and the amount is 45820. Okay.
Like that.
45820. Yes.
Okay, yeah. So there is errata because yeah, you can't get the answers that are there. So errata from my UNISA. Just write that down, and then we can look at it. Okay, so then I'll just adapt my workings for this one then. But let's have a look at the first question. So question one. Let me put up the assignments. Okay, there we go. All right, so when you look at a question like this, remember it's a disclosure question, and obviously because it's multiple choice, they're asking you to work out specific things, so you're not going to have to draw up the statements. Right, but I've done that for you in the workings. I've drawn up the statements if we need it, or the parts of the statements if we need it. Right, so just to test your basics, let's go down this list. Obviously, the ones that you don't know, I'll obviously explain. So the first two you won't know, but you'll have an idea because when we spoke about those basics in the first week, we said in this particular module, you're going to be taking your basics. For example, capital is not just capital. Capital is going to be broken up into capital for partnerships, capital for CCs, and capital for companies. Right, this is a capital account. Right, so members' contribution, it doesn't matter how many members we have. Members' contribution is the vocabulary that's used to describe a capital account for the owners of the business. That's all. Okay, so members own the CC. Remember, CCs still exist, but you just can't register new ones. Okay, so if you're going to register a separate legal entity as a form of ownership, you have to register a private company or a public company. That's the only option. CCs used to exist before the Companies Act was adapted and changed to obviously bring CCs in line with companies, because CCs were, inverted commas, abused in terms of their form of ownership because of the benefits that form of ownership had provided. All right, so obviously legislation changes and government has obviously clamped down. So currently, existing CCs will continue, but they actually follow the legislation like a private company would do. Okay, so that's just capital. Retained earnings. Retained earnings is profit that's kept aside within the organization. So retained earnings is similar to appropriation or profit and loss, but with retained earnings, the word retained is important because when a company or when a CC operates, because they're a separate legal entity, all right, they're basically, inverted commas, juristic persons. Okay, so they're juristic persons in the eyes of the law because these entities can exist forever and ever and ever. Right, so there are certain companies in our country that are over like 100 years old, right? And those companies will continue to operate for another 100 years as long as they obviously manage their finances and they provide good products and services. But the point is, they're separate legal entities. So in other words, they will conduct and run their business practices as though they were, inverted commas, like an individual. Okay, so they're independent, they're like an individual, they're called a juristic person. So when CCs operate, they set aside their profit and loss as retained earnings. So retained earnings is just the way that the CC refers to its profit that they've derived from the operations. Not all of the profit is paid out because the members are separate from the business. Think of a large company, right? Those employees or those shareholders, they're all separate from the company. The company will continue forever and ever and ever. Okay, those individuals can change. The shareholders can change. Employees can come and go. But the business, the legal entity will continue to operate. Okay, so that's capital. Retained earnings is also a form of capital. It's actually more equity. Okay, but equity will obviously make up of different components, right? So this is made up of the members' contribution, the drawings, okay, or the distribution. Okay, they don't talk about drawings, they talk about distributions. All right, so that's one you also won't know. Interim profit distribution just means I've paid out some of the profits to the members, which are the owners of the CC. Okay, this one you might not know, but it is something that was covered in 1502. Okay, when they spoke about those non-profits, right? They spoke about those funds, and you have like a reserve. Okay, so a reserve is viewed as equity, and the reserve would be disclosed as equity in the statement of changes in equity. Right, loans from and loans to, things you haven't seen, but logic will tell you what they are. So if you have a loan from, so in other words, you're running this CC, whatever it is, Y Blue Close Corporation, okay? If you're running this CC and you have a loan from a member, if it's a loan from a member or a loan from whoever, it doesn't have to be a member, it could be a loan from the bank. If it's a loan from, do you think this is an asset or liability?
Liability.
Good. Okay, so the same basics apply. Right. The only difference here is you have a member who is linked to the actual CC in the form of an owner giving a loan, okay, or taking out a loan, either or. Right. So loans
So
from, yes?
a question on that. So so if we take a loan from a member, will we show it in the books of the business? So like your statement of financial position,
Yes.
or will we show it in your statement of changes in equity?
Yeah, it's a good
Like how
question.
we do.
You actually show it in both because of the additional disclosure for CCs. Because remember, CCs are separate legal entities, but members are the ones that enjoy the benefits of the legal entity. So it's actually it's it's disclosed in two sections. It's disclosed in the actual statement of financial position, but it's also disclosed in the SOCI because the SOCI relates to the ownership. So if I've got owners of the business, I need to show the equity. So the loans that you have between members and the CC are also incorporated in terms of additional disclosure. Yeah, so that's just something to consider. So you're not double accounting, you're just disclosing it in two different sections. That's all. Okay, but yeah, it's a good question. Just remember if it's a loan from, okay, from the business's point of view, you've taken out the loan, so it's a liability. If it's a loan to, you've given out the loan, so the loan is viewed as an asset. Right? If you give out a loan, you get the future benefit. It's a resource that you control. Does that make sense?
Yes.
Okay, good. All right, so those are the ones that you probably don't know, but you will later on when we get to those sections. Right, the rest you can probably identify. So, what is that? What type of account is that?
It's a negative asset.
Good. This one?
Asset.
That one?
Asset.
Fixed deposit?
So sorry, remember now, so we're going with non-current asset.
Yes. Okay, because it's a fixed deposit, your assumption would be greater than 12 months. Right. If it's a short-term fixed deposit, then they have to be more specific. Right, but the word fixed deposit automatically alludes or let's say relates to the actual long-term nature of this as being an investment that's longer term. Okay, so if they spoke about a money market account, if they just spoke about a current account, then that would be short term. But because the word fixed deposit is there, I would always go with this being long term rather than short term, unless they explicitly give you something in the question saying that it's going to be maturing in a year or less than a year. Then it'll be short term.
Okay.
Okay, inventory.
I went with assets because
Yes.
it's the closing.
Well, it's not
Uh,
closing inventory. It could be. Obviously, you'd have to look at the dates. Okay, so it is, but
yeah.
obviously, this is pre adjustment. So you might have to adjust some of these. But inventory, as long as you know what it is, inventory is
Okay.
inventory. Inventory is a current asset. And then you can have inventory for consumables. This would be more like a stationary on hand scenario, okay, where you haven't used
Okay.
all the consumables. Then you'll have consumables on hand. Instead of using consumables on hand, they've just referred to it as being inventory.
Okay.
What is that?
Liability.
Good. This one?
I was confused. Bills receivable. Is that? I had no idea.
If something is receivable, what
Is it
does that
like a
mean?
debtor?
Yes, there we go. You got it.
Oh,
So it would be similar to debtors.
so an asset.
Yes, a current asset. If it's payable, it's obviously,
A liability, so
yes, the
creditor.
opposite. Yeah, so if something's receivable, remember accrued income is receivable. Okay? Debtors
Then
is receivable. Right, so trade receivables or bills receivable. If something's receivable, there's some sort of resource that will generate future benefits. And the same with something that's payable. If it's payable, there's an obligation, okay, with an outflow of benefits in the future. Okay, depreciation, accumulated depreciation.
negative asset,
Yes. Accrued expenses.
liability,
Yes. Prepaid expenses.
asset.
Okay, here's the one we have to fix. Okay, so Eunice said there's a problem with the question. Let's just fix it. They said this must be a debit, not a credit.
Yes. And it needs to be 45820.
Okay, perfect. All right, petty cash?
Asset.
Yes. Interest on loan?
Expense.
Good. Debtors?
Asset.
Good. Creditors?
Liability.
Yes. And then SARS, income tax. This you probably won't know because we haven't looked at tax yet. SARS will either be an expense or a liability depending on whether you're owing them or whether you're recording an expense. Because it's a debit, right? Expenses have debit balances, so this must be an expense. If it was a credit balance, then it would be a liability, right? And it wouldn't be income tax. It would be tax liability or unpaid taxes or SARS liability or SARS tax liability, right? The word income tax wouldn't be there if this was a liability, right? Because there's a debit, there's more confirmation that this is an expense, right? And then obviously there's profit before tax, which needs to be adjusted for. Okay, so let's see if you could do the adjustments. The adjustments, obviously some of them you won't know. This is one of them you won't know. So when there's an interim profit distribution, right, what you do know though is how to pay out drawings. Okay, so when you have a drawings type scenario, what do? You debit the drawings and you credit the bank, right?
Yes.
Okay, the same thing will apply here in a member's distribution consideration for a CC. So here they said in addition to the interim profit distribution, they're going to pay members that amount and that amount for yellow and blue. Right, so if you relate this to a CC scenario, you're not going to have drawings, you're going to have debit distribution to members. Distribution, okay, to members. Right, and then you'll credit the distribution payable to members. Right, here they said you need to pay. Right, so because it's need to pay, I would have assumed that this is outstanding. So if it's outstanding, it'll be a distribution that's payable. Right, meaning you haven't paid it yet. Right, if it's payable, it's obviously a liability. Right, if they said it was paid, then you would put it, you would offset it against bank. Right, and then we'll look at those workings. Right, so when I read this, I said, in addition to the interim profit distribution, the following needs to be paid. Right, needs to be paid to me means it hasn't been paid yet. So it's a distribution that is still payable. Once it's paid, then they will obviously debit the liability, so they'll debit the distribution payable, and then they'll credit the bank when it's paid. Right, so you're debiting the drawings, okay, which is the distribution to members, and then you're crediting either bank if you're actually paying it, or you're crediting a liability, which is called distribution payable. And then obviously the distribution payable will be paid at some point in time in the future, and then you'll debit the distribution payable, and then you'll credit the bank. Okay, don't worry too much about this. It's going to come up later on in the notes. But I'm just sharing some of it now because obviously you need it for the actual first 4 questions. Okay, the rest we can go through later on, and then you can come back and you can look at this assignment again, and even try to do it on your own and then check it with the answers that I've sent you. At least then you've got a good set of questions that you can actually use to practice. Okay, so that's something to highlight in terms of the comparison between things that you know. Okay, draw from your knowledge that you have already and then just relate it to something new, that's all. Okay, but if you had to compare the two, they're exactly the same. They're just using 2 different words to describe it, that's all. Okay, so that's something just to note. I'll show you where I've put that later. All right, this taxes we spoke about earlier. Tax is an expense. Right, how much tax did you pay? 40,500. How much tax are you being charged for the financial year? 37,150. Right, so remember, SARS is going to evaluate your taxes each year, and then they're going to decide whether you're owing them or whether they're owing you. Right, so sometimes Maybe you're aware of this process. I don't know too much about your background other than you're obviously studying at UNISA this semester and you had covered some of this last semester in the first module. But in terms of background, like I don't know if you're working part time or if you're like, did you finish school and just come into studying, or like did you take a gap year? Did you work, like that type of thing? So if you have some experience in terms of having worked for a company or part time or something like that, right? You're probably familiar with tax as being part of your salary or pay slip, okay, where you've got to pay a certain amount of taxes, right? So businesses have to do the same thing, right? During the year, the business needs to estimate a certain amount of tax that they're going to have to pay SARS, and they've paid SARS 40,500. Okay, when SARS does the calculation at the end of each year, then they take everything into consideration, and sometimes the amount is less than what you expected. So, for example, how much were they supposed to pay? 37,150. So they've actually paid too much. So because they've paid too much, it's viewed as kind of like a prepaid expense, right? Where you've actually paid for taxes ahead of time, right? You've paid 40,500, but you were only supposed to pay or incur taxes of 37,150. Right, and that's something you'd have to provide for in an adjustment. All right, and then we'll look at that just now. All right,
So for the
these are yes.
when so if we considered it to be an expense, when we get reimbursed with our tax, would it be an income?
Well, it can be reimbursed, but if it's reimbursed, then you're just going to lower the expense. That's all. You'll lower the expense,
Oh,
and you'll
okay.
debit the bank, because the
Okay.
expense would have had a debit balance, right? So it would be debit SARS income tax. Okay, so debit tax as the expense, and then you would have had credit bank during the year. Right, that's what happened here to create this
Okay.
40,500. Okay, so that 40,500 was paid during the year. That could have happened in June. Okay, at the end of the year, all right, they've done a calculation and they see they're only supposed to pay 37,150. Right, so this amount is actually too high. Right, so if SARS is going to give you a refund, then the refund would just be the opposite: debit the bank and credit the tax.
Okay.
Okay, that's if they're going to refund you for that amount. Right, they don't say anything about that. They just tell you how much they've worked it out. Right, so you can't assume that they're going to pay this out. Okay, so what are you going to do? You're going to assume that you've debited, okay, your prepaid taxes, prepaid SARS taxes, and then you'll just reduce your income tax. That's all. Okay, so I'm reducing the tax expense. I'm reducing this by crediting that and showing a prepayment because I've paid for more taxes than I should have.
Okay.
Okay, but yeah, don't worry about those things. Like I said, you'll get it. You'll get it later on when we actually look at the notes. All right, these ones you can do. All right, so did you look at that adjustment?
I did.
Okay, what did your diagram look like? Did you get an interest? What was your interest for the year?
Right. Here's my paper. Can you just give me 1 minute?
No problem. Yeah, don't stress.
I have my assignment at work and I have the answer
Okay, what was the answer?
for question number 3.
Yes.
Question 4. I couldn't get an answer, so I just have the numbers worked out. Like I
Okay,
have
give me
33.
the workings that you had done. So, what did you work out? Did you work out interest here?
I did
Okay, how
work
much
out
did you get
interest,
for the
but I
year?
circled. I don't know. I can't find the paper. I just have the answers on my actual assignment.
All right. So, what answers do you see? Do you have an answer there for interest? Interest on long-term loan.
I don't think you're understanding me. I can't find my paper. I just circled question 1, 2, 3, and 4 on the paper on
Oh,
the
okay, I
assignment.
get it. So when you say answers, you've just highlighted an option. That's all.
Yes, I don't know where
Okay,
I
what
have my
option did you go
paper.
for? Well, this one you probably didn't do.
Option number or question number 3.
No, number one.
Okay, I didn't do number 1.
Yeah, number one. Okay, it's fine. All right. So if you read this, tell me what's happening here.
Okay, so basically we took a loan from the bank, and I know I had to minus. So then for the first term, it was actually 36,000,
Good,
somewhere around there.
yes. That's correct.
So
Okay, so if you read this scenario, tell me what you think about. Like describe it. Tell me what to draw up, and then I'll
okay,
visualize it and see if it looks the same as my drawing.
okay. So we took a loan on the 1st of May, 2018. So that's where I started my diagram for
Good.
12% per annum. But the amount was the 48,000 minus the 12, which was the 36,000.
Yes. And what period do you have in terms of your year, your financial year? What did you have?
So it was between May and October.
Okay, that's what this is giving you, but the financial year comes from the information here.
So 2020. So the end would be 31st July 2020.
Yeah, so what would the start be?
Um, 1st August 2019.
Yes, okay, so important exam technique, right? You always have to use that, okay, the financial year as your guide, right? So when you have a question that relates to loans and you're looking at time, don't look at those dates, look at the year end and then put those dates on the diagram.
Okay.
Okay, so the diagram should look like this. All right, so I'm glad that you had identified the 48 as being the total at the end of the year. Okay, there's my highlight for the start and the end. Very important because that's going to provide for the accrual. Okay, so if that's the start and that's the end, okay, I've got 48 at the end. I had a new loan on the 1st of October. Obviously, balance to start with, 36,000. Okay, did I have the 36,000 Rand loan for the whole year? Yes. So the interest on that loan will be times 12%. Right, did you have this loan for the whole year? No.
No.
October to July is 10 months. Okay, so pro rata interest there. Do you see that?
Yes.
Okay, so if I'm looking at the expense, how much interest am I paying on this loan? I'm paying that portion plus that portion, which gives you that total. Right, because remember, the question gave you this. It's still on screen here. Profit before tax before any applicable adjustments. Right, so that amount that you've got there, that figure, 311480, needs to be adjusted for these adjustments. Right, 2.1 doesn't affect the profit. Okay, because this isn't going to affect the profit. This is what happens after you've worked out the profit. Right, the taxes will affect the profit. That's why I've got tax there. Okay, tax is the last thing you have to subtract from your profit before you start paying out any drawings, okay, or any distributions. Okay, so 2.2 is there. Okay, that you obviously that you won't know, but I'm just explaining it. Okay, so profit will have tax, and because this is a separate legal entity, you take out the tax to get the profit after tax. Okay, the loan is
So,
what you've
so
identified.
is return earnings the same as profit?
No, retained earnings is profit that you've set aside for future periods. So it's profit that doesn't get paid out. That's all it is. It's retained. So think about the word retained. Retained earnings. I'm keeping some of my earnings.
But how would you know how much you're keeping? Is it like
Because
a percentage?
because it's a decision that you make as a business. So as a business, you can pay out everything or you can keep some of it.
Okay.
It's like, for example, if you were, let's say you're working and you were earning income. Okay, do you spend all your income?
No.
Probably not, right? So we call it savings, right? Businesses call it retained earnings. So businesses earn income through operations, through sales and services and so on. And then whatever they earn, okay, less their expenses gives you, inverted commas, something that's left over, which we call a profit, right? So if you think about it as an individual, okay, you earn a certain amount of income, you have a certain amount of expenses, right? What's left over is, inverted commas, your profit, right? And we save that or we invest that or we set it aside. So businesses do the same thing. What they set aside is the amount that they have left over after having operated. So income minus expenses gives you profit. This profit, a portion can be paid out and a portion can be kept.
Okay.
Okay, that's what you're looking at.
Okay.
All right, so it's just looking at a decision to either pay out profit or not. Right, it's the same with the sole proprietor. What happens with the sole proprietor? The sole proprietor has income minus expenses, and they land up with profit. Do you agree?
Yes.
Okay, what happens to that profit? It gets added to their capital. So their capital gets bigger. Right, but if they want to take out everything, they can just pay out all their capital in the form of drawings. Then there'll be nothing in the business.
Okay.
Okay, do you see that? So with the sole
Yes.
proprietor, the profit just gets added to the capital. The capital represents everything that the owner has in the business. In other words, the capital represents his retained, inverted commas, earnings. Okay, because you know that profit will be added to the owner's capital, right?
Yes.
Okay, so the word capital is representing the equity in the business. So in this scenario, the business is just keeping profit aside in the form of retained earnings, which is ultimately equity or capital.
Okay, I get what you're saying.
Okay, all right, yeah, we'll look at lots of examples later on. So don't stress too much about the vocabulary now. Remember, this is chapter, I think it's 6 or 7. I'm not too sure what the number is, but it's the CC chapter. Okay, so we're still on partnerships. We've still got quite some way to go in terms of completing the partnerships first before we even get to the CCs. But the CCs are very easy to provide for. Okay, you can see something like this they could have given you in 1502 in terms of a sole proprietor. Sole proprietor has a loan. Sole proprietor took out a new loan. Sole proprietor had the loan for the whole year. Sole proprietor had the loan for part of the year. Sole proprietor will have interest for the year. Are we okay?
Yes.
Okay, good. All right, so the interest for the loan is the total. That plus that gives you that figure. Okay, but be careful, there is an accrual here. Right, how much is the interest on loan in the question here? 1080. Do you see that?
Yes.
Okay, so that would be seen as what? What adjustment? You were supposed to pay 5520, you only paid 1080.
So it's an accrued expense.
Good. Okay, so the accrued expense will be part of the statement of financial position and it will be a current liability. Right, there's my current liabilities. There's my accrued interest expense, what we just spoke about now.
Okay.
Okay, let's go back to the question. And you had one other one. All right, this one you probably maybe didn't do because you probably saw, okay, it's a member and then you didn't do it. But a loan from or a loan to, it's like any other loan. All right, the only thing that's different is the disclosure, but the disclosure is covered in the statement of financial position and the SOCI. Okay, the statement of changes in equity. All right, so if I look at this, interest on the loan from. If it's a loan from, is this an asset or liability?
A loan. A liability.
Yes. Okay. So if it's a liability, it's going to go in the liability section of the statement of financial position. Okay. It's charged at 12% per annum and it's capitalized. So capitalized means the interest is added to the balance of the loan. Okay. That's what capitalized means. Okay, maybe you knew that or you didn't know that, but now you know that. Right, the word capitalized means to add the interest to the balance. Right, so for example, if you've got a savings account, okay, that savings account will grow because the interest that you earn on the savings will be added to the balance. Does that make sense?
Can you please say that again?
Okay, so if you have savings and you're earning interest on that account, the interest gets added to the balance of that savings. So the balance grows. That's what capitalized is called. Capitalized means
Oh,
to add to the balance.
okay. So you're not. Oh, I remember we went over this. You're not taking it out.
Correct. Yeah, you're not getting paid out. So yeah,
Yes.
capitalized was spoken about when we looked at those financial instruments. Okay, we spoke about
Yes.
investments and savings accounts and fixed deposits. Yes. Okay, that's good. Yeah, so capitalize means to add the interest or the proceeds from the asset to the balance of the asset. Or it could be a liability. Right, so if it's a liability, you add the interest to the loan. Are we okay with that concept?
Yes.
Okay, good. All right, so if you look at what they've told you, right, obviously this is a liability, it's a loan from, okay? The interest is due to yellow and has not been taken into account for this year. Right, because it hasn't been taken into account, you would have to provide for it. If you provide for it, you'd obviously debit, okay, the interest expense, all right? And because this is capitalized, you would credit the loan. Okay, not an accrued expense. Right, because they're telling you that the interest must be capitalized. So you don't show an accrued expense because it's capitalized. So the value of the loan would increase. The loan account itself would increase. All right, and then they say the loan is repayable in full on the 31st of July 2029. Okay, we're looking at 2020. So is this a long-term loan or a short-term loan?
Long term.
Exactly. Okay, it's a long-term loan. So you don't have to disclose it in terms of current assets or current liabilities. Right, so this one I didn't even look at. The only thing I looked at was the interest because the interest is going to affect the profits. Right, so there's the interest. That was the last bit of the calculation. Right, so how do I get the interest? Simple. Take the loan amount, which was yellow's loan, whatever the amount was. The amount was here, okay, 85,000. And then just multiply that by 12% per annum. And then that gives you 10,200. All right, so now that you've looked at all the adjustments, those were all the adjustments. Okay, question one said, what is the retained earnings in the statement of financial position? Right, so I've done the statement of changes in equity disclosure. Okay, I've shown the beginning and I've shown the end. All right, so a retained earnings column is just highlighting the profit that the business is going to generate year on year on year, and obviously you need to provide for the distribution. Right, so what did they start at the beginning? Well, if you look at the question, they gave you an opening balance. Okay, the 24,950 is in the question. That was given. Right, the profit for the year, this is
Okay.
that figure, the amount that you just worked out. Okay, you had
Okay.
to adjust because of those three adjustments. Right, so that's how much profit this business is going to generate. Right, and then obviously, interim distribution was what was given in the trial balance. Okay, 48,000 was paid to the members during the year as an interim distribution, and then 79,500, which was this. Okay, the additional distributions that were paid. All right, and that's the 79,500. It's the two of them added together, the 27 plus the 52. Got that?
Yes.
Okay.
Yes.
And then literally just work out the total. All right, so add and subtract, and then obviously the balance at the end is 156,060, and that was an option. Okay, that was option 2. All right, so the errata
Okay.
doesn't change the first question. The errata doesn't change the second question. Okay, the second question we actually spoke about. You said you got the same answer, either option 2 or option 3 or another option. You were asking about the fixed deposit. Do I or don't I include it? Okay, they didn't tell me anything in the additional information indicating that this is going to be maturing in the next 12 months. So because I can safely assume it's long term. So I am going to include that as part of non-current assets. So just total up, answer, option 3. Okay.
Okay.
All right, and then you've got to look at current assets and current liabilities. So those are short term. Right, if you go back to this, right, can you spot a current asset? Give me the first current asset. Look at them. What's the first current asset?
Inventory.
Yes. Okay, give me some more current assets. What else?
Okay, so I had inventory,
Yes.
bills receivable,
Yes.
accrued expense.
No. Accrued expense is not a current asset. Hold on. Yeah, it's right. It is right. An accrued expense isn't a current asset. Why are you saying it's a current asset?
Accrued. It's a liability. Sorry, I mean prepaid expense.
Okay,
Prepaid
yes. An
expense.
accrued expense would be an expense that still needs to be paid.
So that's a liability. Okay, so
That's a
sorry, a
current
prepaid.
liability, yes. Okay,
Okay, so
prepaid
prepaid
expense is a current asset.
bank.
Okay, you're
Entity.
not going to have bank. Okay, well, now you'll have bank because of the debit. Okay, so I have to change my answer. All right, so obviously the solution has changed now because errata indicated that bank is a debit with 45,820. All right, so
Yeah.
bank is now an asset. So bank will go here. Okay, bank, asterisk, errata, bracket, debit balance. All right, how much? This figure,
Four, five, eight, two,
45820.
zero.
All right, there we go. Okay, so now I've put it in. All right, so then that means this needs to go. Bank overdraft, delete. Okay. All right, what else did you have? Current assets.
Debtors. Debtors.
Yes, and you missed one. What about that one?
Interest on loan. Is that not an expense?
No, what about that
Oh,
one?
I said petty cash.
Did you say petty cash?
Yeah.
Okay, missed that one, didn't hear
Is
it, but yeah, petty cash is a current
yeah.
asset. Okay, your current liabilities, what are they?
Okay. Current liabilities. Bills payable.
Yes.
Accrued expense.
Yes.
Creditors.
Good. And then obviously adjustments if you have any, okay? All right,
Yeah.
what's special about this one?
It's a negative asset.
Good, so what are you going to do with that?
So I minused it from my current assets.
Very good, yes.
From
Well, not
debtors.
your current assets, your debtors, your specific assets.
Yeah.
Yeah, okay, that's good. All right, so if I update my solution with their errata, the loan 2 is something you have to consider. Right, they didn't mention this was payable later on. Remember this one? Okay, they spoke about yellows payable in 2029. Okay, that's long term. Right? They didn't say anything about this one, loan to blue. So if they don't say anything about the loan, you have to assume it's short term. Okay, unless they tell you it's payable and when it's payable. There's nothing in the question here that tells me anything about the loan to blue. Okay, they told me about the yellow loan, they didn't tell me about the blue loan. Does that make sense?
Yes.
Okay, so that was my assumption. I assumed this was short term. There was no information to say otherwise. Right, you had all the other ones except the prepaid taxes, but we spoke about that. Okay, we spoke about it earlier. All right, remember we said you paid 40,500, but you were only supposed to pay 37,150. So it's viewed as a prepaid tax. You've paid more than you were supposed to. All right, so I get that answer if I bring in the bank errata. Is that an option? Let's check.
Yes, it's option one.
Okay, it is an option. All right, great. So now we can get an option. Option 1, good. All right, I had a question about 3 and 4, but now we've got the answer. All right, great. Okay, and then the last question was looking at the current liabilities. All right, so you told me what we had. The only ones that we haven't discussed, the bills we spoke about, that we spoke about, that we spoke about, the distribution. Okay, I mentioned when we were explaining it. Okay, remember we said, okay, this was something that was highlighted here when I read this. Here, where is it? This bit needs to be paid. Okay, when I read that, needs to be paid means it hasn't been paid yet. So you would debit the distribution, okay, to members, and then you would credit the distribution payable to members. And that's why I've got this. All right, so this is there because it needs to be paid. Okay, so there is going to be a liability to provide for. Right, the short-term loan, this is important in terms of disclosure. Did you get that?
No.
Okay, be careful. Right, when you look at this question, okay, what did they say in the question here? The full loan is repaid in 6 equal installments. When is the first installment payable? March
First,
2021. Is March 2021 within the next 12 months?
yes.
It is. Okay, so a sixth of the loan. 1/6 is short term. Okay, the rest of it, so 5/6 of the loan is long term. Does that make sense?
Yes.
Okay, because they wanted short term, I'm not going to worry about the long term. I just need to find 1/6 of the loan. So a sixth of the loan is 48
What?
divided by 6, so 8,000. That's just a disclosure consideration. Don't forget about that. Those are easy marks, and you should look for this. Look for this in past paper questions. Okay, they're always going to give you something regarding that. Okay, I've seen that quite often, and it's such an easy consideration. You literally just need to read the question and just find the portion that's short term. Right, I'm going to pay one installment within 12 months. There's the one installment. Right, and then the accrued interest we spoke about earlier when we did the calculation for the loan. Right, I'm getting an answer now after having taken out that bank amount because there's no overdraft now because of the errata. Is that an option?
Yes. Option
14.8,
4.
yeah, it is. Option 4. Okay, great. So at least now we have answers to these last two. All right, perfect. Okay, so those are the ones that you could have tried and looked at in terms of adjustments. Okay, the rest of it you can't do, obviously, because we haven't looked at those sections. Those sections are actually the last few sections of the actual course. And yeah, we're not going to be able to do that now. We need to cover the rest first. Okay, so I'll do the rest. There's still a few more questions to complete, and then I'll send it to you later in the week. And then you can look at them, you can look at the answers, and then later on, once we've covered the content, come back to these questions. Try do these questions on your own, and then just check it with the answers that you would have had from today or from this week. Okay, is that all right? Are we okay with that?
Yes.
Okay, perfect. All right, so let's close this. I'm going to save it. I'll do the rest of it later or tomorrow or sometime during the week, but you'll get it before next week, definitely. Okay. Let's have a look at the homework. How did those maths workings go? Did you cope?
Yes. I
Easy,
did.
difficult?
It was okay.
Okay,
Really, I
so
think only one I had to do it again
okay.
because I just multiplied the bottom and forgot the top.
Oh, okay, yeah. So silly maths errors, but yeah, just be
Yeah.
careful. But always use fractions. You can't go wrong if you use fractions because the answer you get is actually in the ratio already. You can try it if you like maths and you want to try it. Try do it with percentages or decimals. You'll see you're not going to get anywhere close to the profit sharing ratio. You're going to have to convert it at the end to a fraction to get the profit sharing ratio. It's not as simple. So I would rather just start with fractions, use fractions, and just keep it in fractions because the answer will be the answer. Okay, so
Okay.
you're happy with the maths. I don't have to go and look at those again. You sure? 100% sure.
Yes, I'm pretty
Okay.
sure. So yeah.
All right, awesome. So if you're happy with that, exercise 4.1 was the last one we looked at last week, okay, where we looked at the valuation account. There are a few more examples that we need to look at in chapter 4. So chapter 4, remember, looks at a change in ownership. That was the last thing we spoke about last week. Okay, just to recap some of the basics in terms of theory. Right, when the ownership changes for whatever reason, okay, it could be a retirement, it could be someone leaving the business, someone entering the business. Okay, and we remember we're looking at partnerships. All right, so let me see if you remember this. A partnership, separate legal entity or not?
Not.
Good. Right, so if they're not a separate legal entity, how do you disclose the partnership's interests? Do you have to show it separately or do you have to show it combined?
The partnership's interest.
Yeah, so in other words, their
Separately.
capital, their drawings, their current accounts.
Separately.
Correct. Okay, so when you look at a change in ownership. Every single partner is separate. The partnership is what's together in terms of operations. In other words, what they generate from the business is shared amongst themselves. But what they have is their own. Okay, so partner A, separate from B, separate from C, separate from D. Okay, it doesn't matter how many partners we have. All right, so let's go to the textbook. Okay, do you have a page number? Just so I can maybe enter a number here. Chapter 4, what
80.
chapter, what number is that on? I'm gonna guess. It's
I'm
probably about
on
maybe 80, page 80. Is page 80
I'm on
close?
88.
Okay, 80 is,
88.
80 is close enough, I guess. All right, so there, 4.1. All right, so when we looked at 4.1, we spoke about the valuation adjustments. Right, can you remind us what a valuation is for?
It's when an asset, it's basically an asset or asset that was purchased when the business started or initially that needs to be evaluated at a fair or market
Very
price.
good. 100%, yes. Okay, so remember, a partnership is going to start at a specific point in time. Okay, so A and B.
Yeah.
Okay, there's the partnership. This is in 2000. Okay, now we're sitting in 2020. Okay, and we have A and B running the partnership, but we have C coming to the partnership. Right, so because you have a new partner entering the business, what must you do when there's a change in ownership? You have to value the assets and the liabilities of A and B because that determines their equity. Right, when you look at your assets and liabilities for the partnership, you're establishing the equity attributable to A and B. A will have a share of it, B will have a share of it, and then when C enters the business, C will have to pay a portion for entering the business. And this would be looking at an addition, okay, or a change in ownership, where you're basically letting someone else into the business and they're going to have to pay a portion. Right, we also spoke about C entering the business, paying a portion, okay? There could be goodwill that needs to be included. Right, the textbook describes goodwill here. They say including goodwill. Right, who gets the benefit of goodwill?
The partners, the old partners.
Yes, good. The partners that created it. The goodwill is what's created from 2000 to 2020. Okay, the goodwill, inverted commas, is the increase in the value of the equity that A and B had held previously, but now they're obviously in 2020. Okay. Make sense?
Yes.
All right. It's important to understand that because when we do the goodwill calculation this week, you need to be able to interpret, okay, what's equity and what belongs to the new owners and what belongs to the old owners. Okay, in other words, the old and the new. Right, you always have to look at that. What did the old have? What did the new have? And what do they have together? Okay. All right, so goodwill. If you had to define goodwill, do you know what it is? What type of accounting element is it?
It's an intangible asset.
Intangible, correct, but in terms of its disclosure,
An asset,
which one?
non-current.
Yes, good. Okay, important. Disclosure wise, goodwill will always be on the statement of financial position under the non-current assets section. Right, so had I been given goodwill in that, oh, it's not in this note, it's in this one. Had I been given goodwill here, let's say there was goodwill on this extract, okay, it would have affected the non-current assets.
Okay.
Okay, goodwill could have been given and then goodwill would have been included because goodwill is a non-current asset because goodwill is generated over time. So the existing owners get the benefits. Right, I'm just showing you how they can bring that into other questions. Right, it can come up. Okay. All right, the profit sharing ratio, Unisa has given you some examples here. Okay, you said you're okay with this. You don't want me to go through
Yeah.
any of those PowerPoint presentation questions. You sure you're happy, hey?
Yes.
Okay, great. All right, so then we can look at the next bit, the record keeping. We touched on this last week when we spoke about the valuation account. Right, just remember, an adjustment is a working that's going to be processed when you're establishing the value of your assets and liabilities at a specific point in time. When we looked at this example, okay, we had two partners, Stevie and Bob, okay, admitting Tina. When they admit a partner or when the partnership changes, it doesn't have to be it doesn't have to be when someone enters. It could be when someone leaves. It doesn't matter. The point is, all right, when you have a change in ownership, you must do the workings for the valuation. Okay, so always remember that in terms of technique. Okay, when you have something changing, only for partnerships. Remember, partnerships are covered in 3 different chapters. Normal disclosure, okay, this one, which is a change in ownership, and then you'll still get to a liquidation. Okay, so you've got 3 different chapters looking at one concept. Okay, when you look at those different chapters, you need to identify, what am I dealing with? Am I dealing with normal disclosure, which was financial statements, okay, SOC, that type of thing? Or am I dealing with something like this, where I'm looking at a change in ownership and I have to establish what goodwill is, or I need to provide for the actual new business, okay, the books, the change in perspective. Okay, last week, if you remember the notes, we spoke about a legal perspective and we spoke about a going concern perspective.
Yes.
Okay, those are 2 methods that are used to account for the change in ownership. Right, so they're probably going to discuss it now because we haven't seen it yet. Okay, there's the next exercise. Okay, 4.1 we looked at last week. Here's 4.2. There's a heading here. Let's see. Yeah, it's right. Yeah, change in ownership, legal perspective. Right, so if you go look at those notes from last week, you'll see the legal perspective says you basically have a partnership, A and B. Okay, you close it off completely. And then you start new. And then you'll have A, B, and C. Right, in that partnership. Right, so the legal perspective, it's legal. Just remember, legal perspective means it's according to the law. Okay, the eyes of the law. Right, so if you think about it from the point of view of law, right, will legislation ever view a partnership as being a separate legal entity? No, it won't. Right, so when you close off a partnership, you basically tear up the contract because the contract is no longer relevant or binding. Okay, and then you've got to sign a new contract with the new owners, with the profit sharing ratio, with the interest on capital, with the interest on drawings, etc., etc. Okay, all the terms and conditions. All right, it's like getting married. Okay, remember we spoke about that analogy? Okay, when you look at a partnership, it's like a marriage. Okay, so when you have a marriage, right? If you have to start a new marriage, obviously you have to get divorced first before you can get remarried, if that makes sense.
Yes. Okay. Good.
Okay, so it's exactly the same. Right, just imagine that. Imagine the law. Imagine legislation. Imagine signing a contract and then tearing it up and then signing a new one. Okay, why? Because A and B will or cannot continue operating as A, B, and C without a agreement. Okay, they call that a partnership agreement. Okay, you saw that in the notes, that nice little picture with that little contract in the middle. Okay, that's exactly what you're looking at here. Right, so let's look at it. Okay, you've got Mahatma and you've got Lorato, and they're trading as the clean or the house care specialists. Okay, they're obviously cleaning homes, probably. They're sharing profits and losses equally. Is that important?
Yes.
Good. Okay, so it's 1 to 1. 1 to 1 means 50-50 or 1 over 2.
Yes.
Okay, got that?
Mhm.
All right, they're admitting Enoch as a partner from the 1st of July. Right, so what's going to happen on the 1st of July? You're going to have a new business. It's now going to be called Home Care and Butler Services. Okay, so Mahatma and Lorato, they're cleaning specialists. Okay, then you've got Enoch, which is a butler. Okay, and now they're combining forces. They're joining their skills to make one partnership. Right, what did Enoch do? Enoch deposited a capital sum of 6,500 into the partnership's bank account for 1/3 of the share in the equity, okay, the net assets or equity of the new partnership. That's very important. Right, so when you're looking at a partnership question like this, draw up a diagram. Old, new. Because the diagram helps so much in terms of understanding. Okay, we've got Mahatma and Lorato, and now we're going to have Mahatma, Lorato, and Enoch. Okay, they've got 50-50 in terms of ownership. Enoch's going to pay a third. Not a third. Enoch's going to pay 6.5 for a third. Okay, draw a little diagram. It helps. Okay, so old and new. Right, obviously you've got 3 partners now. We don't know how much they're going to have. Right, we need to read more. Okay, what else do they say? They say the partners will share the profits and losses equally. Okay, now we know. So what's it going to be? A third, a third, a third. Do you agree?
Yes.
Okay. Let's see. 1st July 2015. Remember, that's an important date. On that date, the partnership changed. Right, so you're literally going to wrap up this and you're going to start that. Okay, on that one day. It's literally on that one day, 1 July. Okay, it's a moment in time where you need to provide for the change in ownership. Right. The day before the 1st of July, so on the 30th of June, okay, you had M and L, all right, and then the day after, you've got M, L, and E. Right, so we need to take everything we've got here, and we now need to close off those books, and we need to create a new partnership. That's what we're basically doing. Okay, if we read the rest, they tell you that obviously the amount of money was deposited and they're sharing the ratio, okay? All right, a cash repayment to Mahatma and a cash contribution received from Lorato were recorded in the capital accounts. Okay, so on this date, on the change in ownership, they tell us that M, a cash repayment to M. Okay, so cash paid to M. According to the question. That they don't have to tell you, but they've told that to you. Right, you can actually work that out as part of the question. But anyway, they're giving you lots of clues here. Okay. Right, a cash contribution received from Lorato was recorded. Right, so the partnership... Sorry, say that again. I didn't get that.
So are they saying that Lorato owed the partnership money indirectly?
Basically, yes. Right, because remember, last week or the week before, we spoke about good partners and bad partners. Remember that?
Yeah.
Some partners draw too much on the partnership, then they're owing the partnership. Some partners don't draw anything, and they've got more equity in the partnership. But both are jointly and severally liable for the partnership. Does that make sense?
Yeah.
Okay, so when a partnership changes, because you're evaluating, okay, you're valuing the partnership in terms of owner's equity equals A minus L. Okay, you might have one partner that's out of that's out of it in terms of owing the partnership, or they have more invested in the partnership, right? And then they get that benefit before the new partnership starts. Okay, because remember we said you're wrapping up the old, you're starting new. Are you okay with that?
Yes.
All right. Cash given by L to the partnership. Okay, what else do we have? On 30th June, so notice they're talking about the day before the partnership changes. In other words, old. Okay, on this side. The house care specialists were closed off. Okay, we know it's going to be closed off because they told you this is a legal perspective. At the date, the following items appeared on the statement of financial position of the partnership. The assets were valued in preparation of the change in the ownership structure. Okay, so what do you see here? Statement of financial position. You've got valued amounts here. I just want to make it smaller so you can see more. Okay. Wrong page. Let me save this and close this actually. That's the assignments. Okay, there. All right, let's save that as well. Okay, good. All right, so what do you see here? Capital. All right, so beginning. Well, when I say beginning, the old or the new?
Old.
Good. Okay, so let's write them down. Old assets, old liabilities. We need to keep track. Right, so capital is equity. All right, you can even show that if you want to. You don't have to, but we can put it in. Owner's equity. Okay. All right, so you've got capital M and you've got capital L. All right, 4,200, 3,200. That's the owner's equity for M and L. Okay. You've got current account. You should know from last week that this is what type of account?
Capital.
Yes, so it's also under this heading. Current M, current L. Okay, was M a good partner? No. M was bad. Minus 100. Debit balance. Was L a good partner? Yes. Plus 200 in their current accounts. Right, the revaluation surplus. What is that? Do you know? What type of account is it?
I would say an asset.
No, not quite. It's a revaluation surplus. So it's a equity line item. It's similar to a reserve.
Oh.
Okay, so the revaluation will be seen as part of the equity because the revaluation is attributable to the owners of the business. They enjoy the benefits of that revaluation. If it's a surplus, they've kept it aside. Right, land and buildings.
What do they mean by revaluation?
Sorry?
What do they mean by revaluation?
So a revaluation is when you value the assets. So for example, land and buildings can be revalued. Remember we just spoke about fair value adjustments? Fair value adjustments will affect your assets. Do you remember that?
Yes.
So if you have an investment in a company and the investment has increased in value, then what do? We processed the fair value adjustment. We debited the investment and we credited the fair value adjustment. So this evaluation would have had a credit. If it has a credit, the revaluation is seen as owner's equity.
Okay.
Okay. Right, the old asset, land and buildings. We actually need more space here because I need to put in amounts as well. All right, so the land and buildings, how much? 4,500. Okay, the goodwill, nothing. Goodwill is an asset. Goodwill will arise, okay, when you have a change in ownership. Okay, inventory is an asset. Okay, the inventory was 1,500. Okay, the debtors or the trade receivables?
2,000.
Again, that's part of the business, the existing. Okay. Anything else? Yes. Bank favorable. So it's an asset. They had 500 in the bank account. Right, and then the allowance for credit loss would be seen as a negative asset or a liability. I'm going to show it against the trade receivables. Okay, I'll show it as a negative. So I'll have 2,000 less 0. Okay, there is no allowance. All right, perfect. All right, so have a look at this. In terms of equity, how much is the business worth? Sum up. 8,500. In terms of assets and liabilities, liabilities, nothing. 8,500. Why does that match?
Because of the accounting equation?
Very good, yes. All right, so if you know your accounting equation, processing evaluation is very easy because you're doing exactly that. You're establishing the value of your assets and liabilities and who that's attributable to. Right, so remember when we spoke about evaluation? Okay, here, valued amounts. Okay, 7,500 for land and buildings. Right, give me the working for the valuation. Here's revision. What do we debit? What do we credit?
So we debit land and building, and we'll credit the valuation account. And then we debit the valuation account and credit capital.
Yes, very good. Okay, I must say, you're very good, eh? You remember all the stuff well. I mentioned it earlier. I'm quite impressed that you are so diligent in terms of your studies, and you're probably revising and going over it, or maybe you just have a really good memory and you learn very quickly. But it's very good. I mean, if you remember that, that was something we covered. Was it last week? Maybe I think so, or the week before.
Yeah.
But that's good. So keep it up. Just keep doing what you're doing.
Thank you.
You should get your distinction for this subject as well. You got 70 for the other one, so let's use that as a
Yeah.
goal. Okay, you should get at least 70. Let's try keep that as the goal and maybe more depending on how you do with the actual exam. Okay, and it's multiple choice, so that might even help, but obviously we'll have to be accurate, very, very accurate.
Yes. Yes.
Okay, are you only going to credit capital? Remember, you need to split it because this is a partnership, right? So it's going to be capital M and L.
Capital
Okay, so what's the amount going to be?
3,000.
Yes. And then you're going to split it, hey? So half half.
Yes.
All right. That's important. There's a reason why I'm showing you this. Okay, I don't even know what they're doing with this anyway, but it doesn't matter. Okay, the point is, do you understand what's happening in the question and can you get the workings? Right, these are workings. Right, I'm going through the workings now. Right, I wouldn't do the workings first in an exam. Okay, because in the exam you need to be selective with your application because you can't do everything. You don't have time to do everything. Right, we've got time now because we need to understand the stuff so that when we get it in a specific question, then we can just apply it. Right, so if it was an exam, I would start with the required. I would read what they want and then I would do the question. Okay, here I'm just showing you all the stuff that we've done so far just to go through more of the basics so that you're comfortable with how to process evaluation. Okay, because the evaluation is clearly part of the question. But knowing UNISA, they're probably going to combine it instead of showing it separately. It doesn't matter how you do it. If you show it separately, it's easier to do it this way. If you combine all of it, I can just take my separate transaction and then just put it all together. It doesn't really matter. Okay, but as long as you can get the right workings, you're on the right track. Okay, goodwill. Do we have goodwill? Yes, we do. Right, who gets the benefit of goodwill?
The old partners.
Exactly. Good. So what are you going to do? You're going to credit their capital and you're going to debit the goodwill. Why do you debit goodwill? Do you know the reason?
It's a non-current asset.
Exactly. Okay, basic accounting. Assets increase on the debits. If you want to add in your working. Right, how much do they get?
2,100.
Yeah, did you have
Just
a question?
Yeah,
Yes.
so would you have any evaluation account for goodwill?
No, you don't value goodwill. Remember, goodwill is calculated when the other partner is paying for a portion of the business. There is no goodwill calculation here. Okay, because they told you the goodwill is 2,100.
Okay.
Right, they would have worked it out for you. They would have looked at the old and they would have looked at the guy that was coming in. Okay, Enoch. Enoch paid 6.5 for 1/3 of the business, and then you have to work it out. Okay, you don't have to work it out if they've given it to you. Because remember, goodwill can only be measured reliably by the accountant by looking at the purchase goodwill that takes place when this transaction is concluded.
Okay.
Okay, so we're just going to record it as is. Right, they've done it for us. Valued amounts. Okay, so don't try work it out because you don't need to. Okay, if you're going to work it out, you might get the same answer, but you might get a different answer. You can't use something different because they're giving you the actual amounts. Okay, so just use whatever they give you.
Okay.
Okay, what is the goodwill? You told it, you said it, and you told me it needs to be split, right? Okay, so half half. Do you agree?
Yes. Yes.
Okay, see, these are just basic workings. Okay, looking at the valuation, all right, looking at the goodwill, processing goodwill as an asset. That's all. Okay, what else do I have? Inventory. Okay, you do this one. What's happening to inventory?
The inventory is decreasing. So you debit valuations and I credit inventory.
Yes, okay, very good. I'm just going to put a note here, just so you know what these things are. Okay, I'm not writing narrations. I'm just writing down, I'm just putting a little note next to them. Okay, and then this one, valued inventory. Okay, so you said debit the valuation, agree, credit the inventory. Okay, what else? You can't only have that.
And then I would, so then I would debit capital
Yes.
and credit the valuation.
Very good. Okay, good. Remember, we saw that previously. The valuation can't always work itself out. If you can get the one half,
Yes.
it's easy to get the other half. And you're going to show how much. What's the valuation going to be? What's the inventory going to be?
300.
Yes. Okay, you can see the difference is 300 because you had 1.5 recorded in your books. The inventory will decrease in your books. The valuation account will work itself out and the benefit goes to the partners. Well, in this case, it's not a benefit. It's more a detriment. Okay, it's a disadvantage. Okay, it's a disadvantage having inventory lose value. Right, the inventory has lost value. Right, half of it's going to go to M and half of it's going to go to L. Got that? Make sense?
Yes.
Good. Okay, next, what do we have? Trade receivables, it's valued at fair value. Do we need to value it?
Yes.
No. Bank, the cash is obviously fair value. That I don't even know why they gave you that. Cash is cash. Okay, here we need that. Okay, allowance for credit losses. That we need. What are we going to do?
So I would credit allowance for credit losses and debit valuation.
Very good. And then?
Wait, debit, and then debit capital and credit the valuation.
Good. Okay, so it'll basically be the same as the one above, except you're processing a negative asset instead of decreasing an asset. So the allowance for the credit losses would go there. Again, if you have an allowance, that allowance is telling us that these partners, okay, M and L believe that they're not going to collect all their outstanding debtors. So when they value the company, okay, they've agreed that there needs to be an allowance for credit losses of 300. Right, that allowance for credit losses is going to affect their entitlement. Their entitlement is going to decrease by, it'll be 150 again, yeah, 150, 150. Okay, 300, 300.
Yes.
And that's it. Now you've done all the valuations. Okay, perfect. Good job. All right, now let's go see what the question wanted. Right, notice we've read the question, we read everything, we processed everything. Now we just need to answer it. Okay, they said prepare the journal entries. Okay, so journal entries, you've actually done it. What do they want though? Oh, okay, they want you to process the journal entries for the admission of the partner. Right, so if it's an admission, admission means we're adding the new partner and we also need to record the dissolution. Right, so have a look at this. Okay, there's a reason why I showed you these workings. It's because earlier we had a diagram. There's my diagram. Okay, what's going to change here in my diagram? Well, if I move this across, will it change everything else? Yeah, it will. Okay, let me just do this then carefully. I want to just add a line here. Okay, let's make it bigger. Okay. Yeah, let's also do this here. Here. I need a bit more space there as well. Okay, so earlier we spoke about the old and we spoke about the new. Remember that?
Yes.
Okay, we said the old asset is, well, not the old asset, the old partnership is comprising of the owner's equity, okay, that M and L have in the business. Right. What is happening on the date of the change in ownership? They're valuing the business. So, all these inverted commas adjustments / valuations, okay, need to be accounted for. All right, so let me show you what I mean. I'm going to highlight those. Okay, credit is good. Okay, what does that do to their capital? It increases their capital. Right, what does that do to their capital? It increases their capital. Okay, inventory. This was a decrease. That's not good. That's going to decrease their capital. Okay, and then the allowance will decrease their capital. Right, so when you're looking at a change in ownership, okay, remember those assets and liabilities are changing in terms of value. So, land and buildings. How much is the land and buildings going to change by? Actually, this must go back, that side, and then we're just going to add here. Okay, the land and buildings we said was going to go up by 3, hey?
Yes.
Right, plus 3. Okay, which gives us 7.5. Right, we said the inventory was going to come down by 3. And it's going to end up as 1.2. Okay, we said that there's going to be goodwill in the new business. Right, so in the new business, we have goodwill. Here's the new, NB, goodwill, 2100. Right, what else do we have here? Inventory, oh, we had inventory. That one, nothing happened? Okay, the allowance. All right, the trade receivables. I'm going to take off the allowance from the debtors. So minus 300. Okay, that's now going to be 1700. Okay, so do you see? I'm updating the old. Okay, I'm doing it this way so you can see it. Right, you can see the old assets. You can see the old liabilities. Okay, you can see the old equity. Okay, the old equity needs to update because M and L are entitled to capital benefits and disadvantages, okay, or additions and subtractions, basically. Right, so this is going to increase their capital. So L is going to have plus 1.5. Okay, let's just look at L first. L has plus 1.5. L also has plus 1050. Okay, L will have minus 1.5, well, 105, 150, and minus another 150. Okay, there we go.
Anthony, your numbers are a bit different. If you go down a
Capital
bit.
L. There's capital L. There's capital
Okay,
L.
the next one.
There's
Yeah,
debit
why is your goodwill split
L.
differently?
And there's debit L.
For goodwill?
Where's goodwill?
I think it's just a typing error.
Here's goodwill.
Yes,
Oh,
the capital
you mean?
M also.
Oh, yeah.
Yes.
That should be the same figure. Yes. Thanks. Okay, yeah.
Okay.
It should be the same figure. L and M should have the same figure because it's half-half, 50-50.
Yes.
Okay, perfect. Yeah, thanks for highlighting that. Let's have a look at M. Okay, where's L? We've got L. Where's M? Let's check M. Okay, M gets a benefit of the valuation for the land and buildings. M gets a benefit of the goodwill. Okay, M has to subtract 150 for the inventory and 150 for the allowance. Okay, there we go. Enter. Right, so having considered that, right, when you look at the actual change in owner's equity, okay, the capital is now going to be the 4,200 plus and minus all of those things. Right, there's the new, well, that's not the new, that's the updated, okay, owner's equity. That's attributable to M and to L. Okay, let's write that down as well. The 32. All right, the current accounts for M and L. Okay, remember, if you go look at the rules or the steps, if you look at the notes, I didn't actually open those notes. I'll open it, but we don't actually need it. But I just want to show you what I spoke about last week. Remember those steps towards the end. You had a legal perspective and you had all those steps. What set of notes was it? Was it 3 or was it 2? I think it was 3. Okay, let me just find the right file. Where's my PowerPoints? Here. Okay, no, that's 2. Here's 3. No, that's PDF. Here's 3. Okay. All right, so what I want to share with you is this. All right, when you're processing these changes in equity, right, you have to accommodate for those amounts there. Right, this current account, who is going to get the benefit of this current account?
The partners.
Yes, M and L. Right, so you'll see this is a step. A step is to close off current to capital. Okay, because remember we said if you're going to be closing this business, the only account that you're going to have open is capital, because capital tells you what the business is actually worth. Do you agree?
Yes.
Okay, so you can do it according to the steps in the notes. Here, step number 1, close off the partnership books and prepare a preliminary statement of financial position. They've already done that for you. Okay, they've given you a list of accounts. Step number 2, close off capital accounts. That's what I'm referring to here. Right, so let's close off the current to the capital. Right, so if I close off the current account M, I'm going to add 100. Close off to capital. Okay, here I'm going to minus 200. Okay, close off to capital. Ooh, start a formula. Okay, and then I'm going to adapt that. Okay, so I need to update these figures. All right, so M is going to have a negative 100. Okay, L is going to have a plus 200. Okay, I'm adapting the old for the new. Okay, so now I've closed that off. That's closed off. All right, if you go back here, you'll see apportion any reserve to the capital accounts. Okay, so if I'm closing off the current accounts and I'm closing off the reserve, I need to process those adjustments. Right, those journal entries. So how would you close off a current account? Do you know?
You would debit the current account.
No, be careful. How would you close off a current account with a debit balance?
Oh, with a debit balance. Okay,
because current M has a debit balance.
So I'd credit.
Yes. You would credit the current account. Do you agree?
Yes, and debit the capital account.
Yes, there you go. Good. Simple, easy, applying basics. All right, so there, we've closed off M's capital, well, current to its capital. Right, now close off the other guy's account, or girl. So okay, Lorata, how are you going to close off her account? How do you close off a current account with a credit balance?
So I debit the current account.
Yes, and debit current. And?
Capital.
Credit capital, yes. Okay, Lorato had 200. All right, so there we go. See, we've looked at step number 1 was done for you. Step number 2, you've done. Step number 3, the reserve. Okay, how do we close off this reserve? Who gets the benefit of the reserve?
The partner.
Good, the existing partners.
The existing partners.
Okay, minus 1,000, asterisk, shared to the capital of M and L. Does that make sense?
Yes.
Okay, so M gets plus 500.
500.
L gets plus 500. Okay, I'm updating their accounts. Right, I need to process that. What balance does the revaluation have? We spoke about it. Remember, it's under the owner's equity banner.
It has a credit account.
How do you close off a credit?
So you debit the reserve.
Yes, the revaluation reserve.
And you credit capital.
Very good. Okay, remember to credit both of them, hey? Because they're separate. M and then L. All right, they got 5, and 1,000. Happy with that?
Yes. Yes.
All right, next step. Process any valuation adjustments. We've done all of that. Okay, we actually did step 4 first. It doesn't matter what step you do, as long as you cover all the steps. So I went with step 4 first, and then we came back and we did 2 and 3. It doesn't matter because I know what I need to do. I know I have to update what? My owner's equity. When I update my owner's equity, I know I have to process a valuation, and I know I have to close off any of these accounts. So whether you do that now or later, it's the same thing. Okay, if you like steps and you just want to follow one way of doing it, then just do it that way. As long as you cover all of it, you're fine. Okay, all right, so now I've closed off all of that. Have a look at this. This is something worthwhile that I want to show you. Let's highlight that in a different color. Okay, have a look at the equity. What is the equity now? 13,000. Do you see that?
Yes.
Okay, what are we going to do? We need to compare that, all right, to the old assets and the new assets. So when we're looking at the old assets, okay, you've got the owner's equity, you've got this goodwill. This goodwill is attributable to the existing partners, but it will exist in the new partnership. Okay, I can actually add that here just to show it so you can see that it balances. Okay, goodwill we said was how much? Was it 2-1? Yeah. Okay, and now remember we valued these buildings and all of that. So now let's highlight that block. Okay, this was post valuation, post change in ownership, right? What do we get here? Look, sum up. There's a missing 500. Oh, here the bank. Okay. There we go, bank. Right, so those are the assets. Land and buildings is now that amount. Inventory is now that amount. Trade receivables is that amount. Bank is that amount. Goodwill. Okay, I see I've got goodwill here. Goodwill, we can put 0 here or null. And then let's put the goodwill at the top here. Okay, delete the one at the bottom. All right, it's in the table. Right, what do you notice here? Have a look. The assets and the liabilities must always equal the owner's equity. What I'm doing here is very important because when you do a piecemeal liquidation, you have to follow this process. You need to check that those things are always balancing, so you're on the right track. Okay. All right, so that's something to consider when looking at the value of the business just before the new. Okay, all of this is old. Okay, so have a look at the scenario. This is what the business looked like before they did the valuation. Do you agree?
Yes.
Okay, because they're changing the ownership, they're doing all of this because they need to update what they had previously to bring it to the right point in time. Okay, because remember, this partnership, I don't know when it started, I'm just going to guess. Let's assume it started in 2010. Okay, back in 2010, this is what M and L had. Back in 2010, this is what M and L had. Okay, when this partnership is changing, which was here on July 5th, 2015, okay, they're updating their partnership based on the past, based on what has taken place. Right, so you're basically taking all those balances, you're processing the changes, and you're getting to a stage where you know what the partnership is worth. Okay, at that date. So in other words, just before 1st July. Okay, capital M and L. M has that amount, L has that amount. Do you see that?
Yes.
Okay. What do they all need to contribute? Let's go to the new now. Or are you happy with the new? Are you happy with the old?
Yes.
Do you understand what I've drawn so far?
Mm-hmm.
Okay, perfect. If you look at the rest here, obviously number 5, record the goodwill. Okay, that we've already looked at. Next page. Record the dissolution. That we haven't looked at. Right, when you look at the legal perspective, legal means get rid of the old and then process the new. Right, so how would we do that? Well, again, go down to the bottom. Close off all the old assets. Okay, and then you'd have to look at all the old assets. So go back to the top. You'd have to look at all the old assets. What old assets do we have? Here, the land and buildings. Okay, the inventory, the trade receivables, the bank. Okay, I'll show that to you just now. All right, before I lose you, I just want to make sure you can understand the new part. Okay, because the dissolution is quite simple as long as you can see all the assets. Let's have a look at the new. Okay, earlier we spoke about the new. What did the question say in terms of contribution? What do they need to contribute?
Did you said Enoch contributed 6.5?
Yes, but what did they say after that?
That it's equals.
It's equal. Everybody has to have the same capital.
Amount.
Okay, remember they said the capital in the partnership is in the same ratio as the profit sharing ratio. Do you see that?
Yes. Yes.
Okay, so what does that mean? That means that the capital that they're contributing has to be the same as Enoch. Does that make sense?
Yes.
Okay, so let's go to the diagram, the picture. Here's the picture. In the new partnership, what is M going to have? 6.5. What is L going to have? 6.5. Okay, this is what they actually have. M actually has 6.850 and L actually has 6.150. Do you see that?
Yes.
Okay, so let me draw a little picture here just to show you what's happening. If you can understand this, this is going to help a lot later on. Okay, copy paste. All right, this is the old partnership. Okay, this old partnership had M with 6.850 and L with 6.150. Is that right? Yes. Okay. They're going to take this partnership. Remember, is the partnership still the same? It's identical. So let's delete that. Okay. Copy paste there. Okay. This partnership they've got here is identical in terms of assets and liabilities over here. Does that make sense?
Yes.
Okay, so it's not like you're starting a new business. It's just the accounting that needs to start over. Okay, so you have a partnership. You've got M and L here. Right, when you have the new partnership, you're still going to have M and L. But also going to have E.
E.
Okay, and they're saying that M must have 6.5, L must have 6.5, and E must have 6.5. That's what they're saying. Okay, we know that in terms of the assets and liabilities, owner's equity here equals 6850 plus 6150, 13,000. Okay, owner's equity here is obviously going to be more because E is going to be entering the business, and obviously we've provided for the valuation and so on. Okay, that additional capital. Remember, E is giving money. Okay, he's giving money to enter the business. Right, what are they giving? They're not giving money, they're giving the assets and liabilities they are entitled to. That's what they're giving. Do you see that?
Yes.
Okay, so M's giving a portion of the assets and liabilities, and L's giving a portion of the assets and liabilities. If you look at M, who's better off in terms of owner's equity?
M.
M, exactly. So M is going to give assets and liabilities here that moves there. Okay? That's worth more in terms of owner's equity. So if he's only going to get 6.5, he needs to be compensated for his additional contribution because his share of the assets and liabilities are more than Lorato's share of the assets and liabilities. Does that make sense?
Yes.
Okay, good. All right, so you can see here, if I just move this up actually, or let's move this down rather, it's easier. Okay. All right. M will get paid out, bracket 6850 less 6500, close brackets. Okay, L is going to have to pay in. L will have to pay, okay, 6500 less 6150. Right, to become part of the new partnership. Do you see that?
Yes.
Okay, and the difference is, let's work it out. 6850 less 6500 is 3,000, not 3,000, 350. Okay,
Yes.
6500 less 6150 is 350. All right, so M is giving assets and liabilities worth 6,850, and this is becoming the new partnership where all of them have a share in the new partnership. Got that?
Yes.
Okay, good. All right, so if you're looking at the payment, obviously the one partner has to pay, and there's going to be a contribution, so you'll get cash and you'll pay out cash for the other partner. All right, does that make sense?
Yes.
Okay, perfect.
The only
Awesome.
question would be, how would I disclose this?
How would
Like,
you
how does it
disclose this?
together?
Remember, the disclosure will be a statement of financial position. So the statement of financial position for the old is going to look the same for the new. The only thing different is you'll have more cash. You'll have E's cash, okay, because E is obviously contributing money. But you'll
Yes.
still have all the existing assets and liabilities.
Okay.
Okay. I don't think I've ever seen a question about that in terms of disclosure. Right. For a change in ownership, they like to test this. They'll give you something like that where you have to do workings and calculations to check the actual valuation. Right. So valuations they test. Closing off accounts they'll test. New partnership, old partnership they can test. Changing the values of assets and liabilities they can test. Working out goodwill they can test. All of that they can test.
Okay.
Okay, but you've got everything here. You've got the picture. The picture, it's like how they say, a picture tells 1,000 words, right? So if you have the image,
Yes.
the diagram, it makes more sense because you can see what's happening. Okay, are you
Okay.
right with that?
Yes.
Okay, let's go see what they wanted us to do here at the bottom. Okay, let's just go through it. A lot of this we've already looked at. Okay, here. All right, they've done journal entries. What did they do here? Okay, here's the closing off of the current. Current account to capital. That's what they did there. Have a look at ours. Here's ours here at the bottom. They've combined it. We've kept it separate. Where's it? Here. There we go. There's my closing off. Right. Capital, current accounts, capital, current account. Capital M, here's capital M. Capital M, debited with 100. There's my debit for 100. Do you see it?
Yes.
Okay, current account Lorato 200. That's debit. Current account Lorato 200. Current account Lorato 200. Current account Lorato 200. Current account Mahatma 100. Current account, yeah, there's current account. Okay, there's current account Lorato. Yeah, that's right. Debit current account Lorato, credit current account Mahatma. Capital account Lorato 200, capital account 200. Okay, they've just joined it as one. Okay, so they've just put it as one transaction. It's better to keep it separate, but you can do it as they've done it. Then I would just copy paste that there, copy paste that there. Ooh, copy paste that there, copy paste that here, and copy paste that there. All right. If you like combining transactions, then you would combine it, but it doesn't make sense. Right? It's better just to show two separate transactions and just to write the description twice. Closing off current to capital. That's what I would have done. I would have shown it like that. Okay. They should mark this correct and they should mark that correct. Either or would be marked correct. Right? They shouldn't be so picky about the transactions, because as long as you've got them, they should mark it correct. If this was a written paper, obviously. Okay. Are you happy with that?
Yes.
Okay. Delete that. Delete that. Okay. There's it. All right. The revaluation we spoke about. You had to split it. There was the apportionment. See, they're following the steps in the textbook. That's what I gave you in the notes. Okay. The notes summarize the steps. Step number 1 was close with the current. Step number 2, process the revaluation. There's the revaluation. Okay. That's the same. All right, what did they do next? Okay, they did the valuation. Okay, the valuation, they've done it as one transaction. Remember last week, I gave you all those T accounts and those workings?
Yes.
Here they. Remember these things?
Yes.
I did each one separately, and then they just combined it as one. Okay, I did the same thing here. They've just combined it as one. So let me show you what they've done. Okay, let's see the first one. Okay, they've got the valuation account. They've processed everything in one account. All right, so have a look. Land and buildings debit. There's the land and buildings debit. Do you see it?
Yes.
Okay, the inventory, cleaning material. Where's my inventory one? Further up or further down? Further down. Here's my inventory account. Okay, what did they do to inventory? Inventory was credited. Did we credit inventory? Yes, we did. There's our credit for inventory. Do you see it?
Mm-hmm.
Okay, allowance for credit losses 300. We also had that. There's the allowance for credit losses 300. And then we had, that was it, yeah, the allowance. And then the valuation account is going to be 2,400. Okay, so let me show you that. Okay, if you're looking at the debits and credits, they've just net the amounts off each other. So if I look at my valuation, here's one valuation. Okay, the land and buildings went up. Okay, asterisk L and B plus 3,000. Okay, what else do we have a valuation? The inventory. Here's the inventory minus 300. Do you see that?
Yes.
Minus I in V. Okay, minus 300. Actually, let's do it this way. Land and buildings plus 3,000. Inventory minus 300. Okay, allowance for, I'm just going to write allowance for doubtful debts. Okay, or credit losses. Okay, what is that figure? It was also 300, minus 300. Okay, if we had to combine all of our separate journal entries, then we would have just netted off each other, and then we would have put plus 3,000 minus 300 minus 300 gives you 2,400. That's how they get the 2,400. Okay, I don't like doing it this way because it's so complicated. Okay, how easy was it just to process all of them separately?
It's so much easier.
Yeah, so don't try be fancy. This is fancy. It's probably because they want to save space in the textbook. They don't want to show you 2 pages of this. They just want to show you 4 lines of it. Okay, if they did all of this, it's going to take up another 2 pages or so. Okay, because I've shown each one separately. Right, it's because of space. This is a lazy way of processing transactions, but it's fine. You still get the same final answer. Are you happy with that?
Yeah, the only thing I don't like about this textbook way is that you have amounts for valuation, which in the next block they kind of
In
debited.
this block is looking at the other half. So let me show you this block. Right, you
Yeah.
understood that block, right?
Yes.
Okay, the next block is looking at my capital. So let's do capital M. Okay, what is capital M? Here, capital M went up by 1,005. Here, capital M went by plus 150. Then it went down by 15, and it went down by 150. Okay, do you see that? That was capital M. Copy paste. Then we need to do that for L. Do you agree? So M and L, you need to add and subtract all of that stuff. Okay, there's the one. Copy paste. There's the other. Okay, so did I do that correctly? The capital is 15. 15 plus 15 is right. Minus 15. Yeah, that's right. That's also right. That's for the valuation. Let's see. Is the addition and subtraction right here? Let me check my working. That plus that is correct, and then minus that, yeah. 15 plus that, minus that, plus that. That is correct. That's the capital. I'm missing something. I'm missing 150. Did I miss something? Because it's 2,400, I'm missing 150. Both of these were negatives. Yeah, they were negatives. Unless there's something else here at the bottom. No.
Are you sure we're not
It
missing?
should balance. It should
What
balance
was that again?
because here they're telling you the valuation account is being closed off. So they're closing off the valuation. So the valuation would have been the opposite. So if I looked at the land and buildings, the land and buildings was 3,000. Okay, I've got the 3,000. The inventory was the 300. I've got the 300. Okay, and we're splitting it. 3,000, there's half there. The inventory was 300. That was the half. Oh, it was the 15. The 15 is the goodwill. There's the mistake. Okay, why am I adding goodwill here? That's not part of the valuation. Okay, sorry, I'm just adding all the yellow. Okay, the valuation, this needs to change color. That's not a valuation. Okay, that's the valuation. That's the valuation. That's the valuation. Okay, so that needs to go. The goodwill needs to go. I had included goodwill. That's why it's not working. Okay, yeah, there we go. That works. All right, there. Capital M, capital L. Okay, let me highlight this. Valuation. Let's highlight that. Valuation. Let's highlight that. Valuation. Okay, so when you do a valuation, if you do it as one transaction, so the land and buildings, here, the land and buildings, look at the valuation. Here's my valuation. There's my land and buildings, take the 3,000. There's my valuation, minus the 300. There's the valuation, minus the 300. Gives you 2,400. Okay, this journal entry is looking at the capital. Okay, because the valuation, see, this valuation eliminates with that evaluation. Do you see that?
Yes.
Okay, so it has to work itself out. Right, so if you do it separately, it still works out. Right, so here's the valuation. There's the capital L, there's the capital M. There's the capital L, there's the capital M. Right, there's the value. So those two added together, here's the inventory. Minus those two added together, minus those two added together. Right, you get 1,200 for capital M, 1,200 for capital L. The total is 2,400. It's correct. Okay, is that all right?
Yeah.
Okay, let's see. The next bit, okay, they close with the goodwill. There's my goodwill. That should be the same. That is the same. Okay, and then here, yeah, this is the balances that I was talking about earlier when I highlighted these assets and liabilities. Okay, here, transferable account, asterisk, it's another working account. Okay, when you have a transferable account, all those assets that you had, you're going to close off. What balance does land and buildings have? Debit balance. How do you close a debit balance?
You credit
By crediting it.
land building.
Okay, goodwill. How do you close off goodwill?
Credit it.
Yes, because goodwill has a debit balance. How do you close off inventory?
You credit it.
By crediting it. See, all of those have credit balances. Trade receivables. How do you close off trade receivables? By debiting it. How do you close off bank? By crediting it. Do you see that?
Yes.
Okay. All of these things represent accounts with debits in your actual old partnership. Okay, and then what am I going to process here? This is the new. Okay, closing off the balances. All right, because I'm closing off capital M, closing off capital L to get the new. Right, old to new. Right, so capital M, I'm closing off. So let me show you where we looked at this over here. There's it here. Okay, there, capital M and L. 6850, 6150. There's the 6850, there's the 6150. The allowance, they're just closing it off separately. They're not closing it against your trade receivables. Okay, they've kept the 300 separately. I offset it, remember? I subtracted the 300 from the 2000 there. Do you see it?
Yes.
Okay, right, then I've subtracted all those other amounts, so those are the amounts I'm closing off. So there, 7.5 is what I would have closed off. That's the same as them. Okay, goodwill I would have closed off, the same as them. Inventory I would have closed off, the same as them. Trade receivables, I wouldn't have had the same thing. In mine, I wouldn't have had this. I would have had 1.7 here, because this I wouldn't have shown. Okay, you would have shown that separately. It's up to you. I've just shown it here because I've discussed it. I've offset it. Okay, there's the 1.7. Right, and then bank, 500, there's the 500. Right, it's what I highlighted there. Right, those assets and liabilities become the assets and liabilities for the new business. Okay, so you've closed off everything. Let's look at the new here. Okay, remember we spoke about the new?
Yes.
All right, what is the new going to have in terms of assets and liabilities? New assets, new liabilities. Okay, assets. We need to pull the assets from before. Okay, so here, land and buildings, goodwill, bank, copy paste. Okay, and we need these answers. Okay, let's reference them. Okay. Right, liabilities will actually be 0 for the new partnership. Okay, and what else is the partnership going to have? Money
Equity.
from E. Do you see that?
Yes.
Okay, because if you tally up this, okay, this gave you the 13,000. This 13,000 is M's capital. Okay, this payment we need to process. All right, so how do we process the payment? How do you pay M?
So I debit drawings and
No, debit
credit
capital.
bank.
Because you're paying off a part of the capital.
But wouldn't they be drawings?
Well, if you're drawing means you're taking from the business. Are they taking from the business?
Kind of.
They're not taking from the business. It's not taking from the business. You're paying out capital. Because what are you looking at? You're looking at the new partnership. Does that make sense? It's this new partnership. Okay, remember we said, what does the new partnership have in terms of equity? 6,850.
Yes.
Minus 350 gives you 6,500.
Yes.
That's the new partnership. Right, so to get there, what must you do to the capital? You need to pay off M. Credit the bank. That's something that you have to do. See? You're paying off M. What is L going to do? L is going to pay the partnership. So L is going to contribute more. Does that make sense?
Yes.
Right. L is going to have to contribute more capital. So debit the bank and credit the capital. Right, 350, 350. Okay, what else do we have? Let's check. Do I have all the assets? Yes. Do I have all the capital? Yes. Do I have E's? No, I don't. Okay, and then the last bit is E's contribution. Debit capital E.
No, debit
Not debit capital E. E is a partner, so he's contributing capital, right? Because they said he paid. If he paid, the bank is going to debit. That's right. Okay, asset increase. Just go to basics. Keep it simple. Okay, capital E. Owner's equity increasing. Okay, how much did E contribute? 6.5. There we go. Right, that's for the new. Right, so look at the new partnership. Remember, the new partnership is separate from the old. What will the new partnership have? Land and buildings, goodwill, inventory, trade receivables, bank. Okay, obviously the bank will change. The bank will update with these transactions. Okay, yes. Does that make sense?
Yes.
Perfect. Right, let's see what they've shown. Let's see. Okay, here. See, this is the new. Look, home care and butler services. All right, they're showing the land and buildings. Okay, here they're showing the contribute. Okay, they're splitting it. They're showing the portion of the contribution as part of A and B's entitlement. Okay, so they don't just want you to show the actual land and buildings. They actually want to show the apportionment. Okay, so I'm going to show you how to do that. Okay, remember we worked this out? Owner's equity, 13,000?
Yes.
Okay, what does Mahatma and Lorato have in terms of their entitlement? 6,850 divided by 13,000. Okay, the other person has the 6,150. Okay, because remember when I try to draw the diagram, I'm taking the assets and liabilities here and I'm moving it across there. Okay, those liabilities, those land and buildings, right, this land and buildings, this 7,500, M, in terms of contribution, is contributing a portion of it. That's why they're looking at a ratio. Okay, 6,850 divided by 13,000. Do you see where that comes from?
Yes.
Okay,
yes.
What is that? That is M's contribution to the new partnership. Right, but if you show all of it, if you add up this one and that one, okay, M and L are both contributing, okay, a portion of the total. They're just showing it as a separate amount. Okay, instead of showing it as one amount. Right, I would have shown it as land and buildings, okay. I would have shown it as land and buildings, the total, 7,500. Okay, and then you could have shown, you would have taken it off the capital, right? Because the capital would have been separate, and then the capital would have been a portion of it, right? It doesn't matter. You can show it like they've done it, or you can show it as one total. It should be fine. I don't think they'll penalize you for that, but it's just something to consider when looking at their contribution. Because what did they contribute? 6,850, 6,150, but it's in the form of not money, it's in the form of assets and liabilities.
Okay.
Okay, that's what you're looking at here. You're contributing assets and liabilities. That's what M contributes. That's what L contributes. What does E contribute? E contributes money. That's what E contributes. That's the money. Okay, those balances need to be updated, okay, with those changes. Okay, Lorato, other way around. All right, I see Lorato's at the top. Delete. Okay, this balance needs to be updated with that. Okay, this balance needs to be updated with that because look at the capital. What must Lorato's capital be? Must Lorato's capital be 6150? No, Lorato's capital must be 6.5. Do you agree?
Yes.
Okay, must Mahatma's capital be 6850? No, Mahatma's capital must be 6500. So he needs to reduce his capital. Okay, see, you do have to take it off capital. You have to. Earlier you said it's drawings. It's not drawings. He's not drawing. Okay, he's not drawing. He's getting paid out. There's a difference.
Okay.
Okay, if he was paid out, his capital is being affected. His capital is decreasing. If he was drawing, that means he's taking from his entitlement from the partnership. But remember, this partnership has only started. So there can't be any
Yeah.
drawings yet. Drawings will come up later on. Make sense?
Yes.
Okay, good. Right, do we have another one like this or do we have something different? Let's see. Okay, yes. It's the same, but it's different because looking at this, valuation account change ownership of a partnership. Is this legal or is this going concern? That's my question. You're going to have to look at the information or you're going to have to look at the answer.
It's
Let's
legal.
see. Do they have everything
Under
there? Retire?
it's legal.
Is it legal as well?
Under
Where do you see legal?
under additional information
Oh,
to there we are, the change in ownership structure.
yes. Very good. I agree. Okay, perfect. All right. Can I give you this one to try?
Okay.
Do you think you can manage that in terms of all these workings? Right. I looked at this and I drew diagrams. Okay, let's
Okay.
draw the diagram. Okay, I'll help you with it. This was 4.2, hey?
Yes.
Put a heading here just so you know what that is. Right, and then let's do the same but for this one. 4.3. Okay, so I want a diagram. Draw me a picture. You read it and you tell me what's happening. I want old and I want new. Help me draw the picture.
Okay. Okay. Old we have Callie, Rocky, and Mike. And a partnership and share profits or loss in the ratio. Okay, so then Kelly is 2/5. Rocky is 2/5. And Mike is 1/5. Kelly decided to retire from the partnership. His last day as a partner in the partnership will be 31st May 2015.
Good. What else?
Okay. The new partnership will pay out Kelly's capital in cash on 30th November 2015. Okay, so Kelly's going to get paid out, and then in the new partnership, it's going to be Rocky, Mike, and Jerry.
Good. Is Kelly still a partner?
No.
And now? Rocky, Mike, and Jerry?
Will be 3/. Okay, so Rocky's new thing would new ratio would be 3/6. Mike 2/6 and Jerry 1/6. Jerry will contribute 80,000 Rand in cash for a 1/6 share in the equity of the new partnership. Okay.
Good. What else?
Okay, the following information is taken from the accounting records immediately prior to the recording valuation adjustments. Okay, so then this amounts are old.
Of what? What are you gonna use? Where are you gonna use it? Old or new?
Old. Old.
Good. Okay. What must I write here? Tell me. What must I
So,
show?
yeah, so equity,
Yes, very important. Owner's equity. What else?
uh, assets, and liabilities.
Yes.
Old
There we go.
assets, old liabilities.
Happy with that? Now what? Tell me what's
So
what.
Cali, under owner's equity, capital. Cali's is 56,000. Rocky, 74,000. And Mike, 38,000. Then land and building is under assets, which is 80,000. Inventory, 48,000. Trade receivables, 36,000. Trade payables control would be liability, which is 14,000.
And bank, hey?
Yes, and bank, which is 18,000.
Okay, now what? What do we do?
Okay. To prepare the change in ownership structure of Fighting Fist, the following agreement was reached. Goodwill must be recorded in the books. I would sum it up. Sum up the old and
Yes, very important. Double check to make sure. Does your equity equal your assets minus liabilities? Well, let's check. Right, those are totals. Okay, this is important because when we do a liquidation, you have to keep track of that. Okay, have a look at this. A minus L. Okay, this minus that. Is it the same? It should be. Yes, it is. Good. Okay, so you're on the right track. Okay, now what? Read the information. What are you going to do with this?
with this. Okay, so this is going to be for the new or the valuations, basically.
Yes, this is part of the process to change the ownership of this business from KRM to the new partnership, RMG.
Okay. To prepare for the change, goodwill must be recorded in the books. Okay. That, I think we'll have to get back to that one.
Keep going,
An
yes.
allowance for credit loss must be created at 3,600 Rand.
Good.
So I'd minus it from trade receivables.
No, don't just minus. I want this.
Oh, debit and credit. So I would
Because maybe they'll ask for that, so you need it.
debit allowance for credit loss.
Debit. Debit the allowance.
Because we didn't try credit. Are we doing evaluations?
We're doing a valuation, yes. So in the
Okay, so
valuation, what would you remember?
Debit
Keep it simple. An allowance for credit loss is what?
a negative asset,
Good. What balance does a negative asset have?
a credit.
Yes. That's how you do it. And then you just put the valuation in. And then you just do
Okay.
the other side.
Because the way I was going to do it was I was going to debit allowance and credit debtors. I think that was the way I was thinking
Ooh,
about
no.
it. But
You
okay.
can't because this is a valuation. Remember, this is a change in ownership. Change in ownership,
Yes.
not a disclosure question for adjustments.
Okay.
Yeah, be careful. Right, it's a change in ownership. So, who gets this decrease, this allowance?
The partners.
Yes, KRM. Do you see that?
Yes.
Okay,
So
so
then I would credit the valuation and debit capital.
okay, show the split. What would you do?
So then for Cali, I would say 3,600 times 2/5.
Same for the other guy. Hey,
Or
2/5.
and then Mike's 1/5.
Good. Okay, does that work out? Let's just double check. Yeah, 36 is correct. I'm just looking at the total sum up. Right, there's your valuation. That would be awarded marks if you're doing a journal entry processing the valuation for the second one. Okay, obviously number one we need to come back and look at. If they give us more information, we can work it out. Okay, number 1.3.
Inventories must be valued at 60,000. Okay, so my inventory.
What is inventory worth?
Oh, so it's 48,000. So it's increasing.
Yes.
So I debit inventory 12,000, and I'd credit the valuation.
Good.
And then I would debit evaluation and credit capital.
Yeah, see how easy that is?
Yes.
Okay.
So
how
for
much?
them, the split 12,000.
Good. Ooh. Okay, and then the splits?
So it will be 12,000 times 2/5. The same, and then 1/5.
Correct. Good. Okay.
Okay.
Now what?
Land and building must be valued at 140,000. Okay, so land and building also increase. So debit land and building, credit valuations, and then credit valuation, debit capital.
Good. Easy, hey?
Yes, kind of.
Right.
This part's easy.
Yeah, it's just the basics in terms of debits and credits. That's all. Don't overcomplicate this. This is easy. Okay, and then you can use this wherever you need it. What's the amount going to be?
60,000.
Yes, the difference. And then you would just obviously split it, right?
Yes.
Times 2/5 times 1/5. Okay, what else? Okay, you've looked at everything. The only thing you haven't looked at is the goodwill. Okay, this I'll do for you because you haven't looked at it before. Okay, if you go to my notes, this page is important. Copy paste this. Okay, so goodwill calculation. Okay, when you do a goodwill calculation, you obviously need to consider how much has been paid.
Okay.
Okay, so what does the formula require? The total purchase consideration of the new partner's contribution in terms of their payment. So what do we read in the question? Ooh, where's my question now? It's not coming up here. No, that's the assignment. Close.
Profit sharing ratio will be.
There's it. Okay. How much did Jerry pay?
80,000.
Okay, Jerry paid 80,000 for 1/6 of the business. Therefore, the total 6/6 asterisk 100% cost or 100% worth of the business is 6 times 80,000. Do you see that?
Yeah.
Okay, so the purchase consideration is 6 times 6 is 480,000. Okay, so what is that saying? That is saying that in actual fact, this whole business is actually worth 480,000 Rand. Okay, but that 480,000 Rand must be compared to the equity in the partnership because that's going to create the goodwill. Right, so what is the total equity of the new partnership? That you need to calculate. That you need to work out. Right, so how do we work it out? We need to go back and we need to look at our workings here. Okay, in terms of owner's equity. Right, how much owner's equity does K, R, and M have? Oh, I didn't write it in. Oh, no, I did write it in. Here's it here.
Yes.
Do you see it?
Yes.
Okay, they need to get, okay, a portion or a share of the increase. Right, so I need to insert and move this across. Alright, so tell me about K. Let's put a plus here. Okay, did K get something here? No, K got a minus here. K got minus 1440. Do you see that?
Yes.
Okay, what else? Okay, just read the right lines so we don't make any... Okay, let me make it bigger. Then I won't read it wrong. Okay, there. Okay, then here, K gets a credit, so plus.
48.
And then K gets a plus, 24. Do you see
Yes.
that? Happy?
Yes.
Okay, there's K's capital. Alright, R's capital. What's R's capital? Okay, we need to work it out.
So, yeah,
So
144.
it's actually going to be the same because K and R have 2/3. Not 2/3, 2/5.
Yes.
Or yeah, it'll be the same. R, R, R. Yeah, it will be the same. Okay, so 74,000. Ooh, I need to copy paste all that stuff here. Okay, there's K's entitlement. Okay, what is M going to be entitled to? Okay, let's check M's. M has to pay 720. M gets 24. M gets 12. Right, there's the picture. Let's work it out. 38,000 minus plus. Okay, there's the R and M. Okay, do you see that? Does it make sense?
Yeah. Yes.
Okay, where's our new? Here's our new. Alright, so is K still there? No, K is gone. Do you agree?
Yes.
Okay, is
So
R still there?
Yes.
Yes, R is still there and R is going to contribute what R had. That's R's entitlement. Okay, remember, it's the... Let me draw that little block. Okay, remember this old. This is the old partnership, all the assets and liabilities. Those assets and liabilities are still here, but they just came from K, R, and M. Does that make sense?
Yes.
Okay, remember K they said was paid out, right?
Yes.
Okay, so it's the same partnership. That means R and M are still there and they still have the equity because their equity would have been contributed. So K is gone, R is there, M is there, and now we've got G. Okay, so what is the new partnership's equity? Okay, we need to add this plus that plus Jerry. Okay, there's the new partnership equity. There's an amount that you need. Highlight that amount. Okay, so you have to look at the old and you have to adjust the new. The new needs to represent what R, M, and G have in the actual partnership. Does that make sense?
Yes.
Okay, so now we need to work it out. Where's my formula? Okay, I wrote that in purple. Let me write this in purple. Okay, so the equity of the new partnership, I'm actually just going to copy paste this at the bottom. Okay, there's the 80,000. Oh, that's not 80,000. Oh, okay, I was referencing amounts. Okay, reference. Okay, is that the right figure? Same figure. Hey, yeah, same figure, great. Alright, so now we can work this out. Copy paste. Okay, what is the total purchase consideration? 480,000. Okay, less. What is the equity of the new partnership? 233040. Okay, equals goodwill, or goodwill equals. All right, let's work that on the calculator. Copy paste. There's it. Okay, this is the goodwill. All right, that goodwill, you know, needs to be apportioned between who? Who gets the goodwill?
The old. The
Yes.
old.
Okay, so copy paste. All right, goodwill is seen as what? What element?
An asset.
Good. So you would debit the goodwill, and then you would credit capital K. Notice K gets the goodwill. Hey, you see that?
Yes.
Because K was instrumental in creating it. So K will get paid out a portion of it. Does that make sense?
Yes.
Okay, so how much is K going to get?
2/5.
Good.
Times.
2/5, 2/5, and 1/5. All right, does that make sense?
Yes.
Okay, so that's something to consider in terms of goodwill that needs to be calculated. In this question, we actually had to calculate because it wasn't given. Happy?
Yes.
Okay, great. All right, so you've got the transactions. What you can do is, I think we've actually done it already. Yeah, looks like we have. Okay, you've already given me all of this. What did the question want? Prepare the valuation account and the capital accounts. Oh, okay, so they want T accounts. That's what they want. There's the T accounts. Right, it's the same thing. You just have to show the balances. Okay, so go look at your workings here. The workings is the answer. Okay, here's my working for the valuation. Okay, obviously I need to add up. So K in this account. Okay, maybe add this to your working. If you've got a printed version of this, okay, let me show you. Capital K would equal. It's a debiture, so it's minus 144. Actually, we've done this already. Why do I need to do it again? It's here. It's at the top there. Copy paste that. Copy paste that. Copy paste that. Okay, there's the one amount. Copy paste that. There's the other amount. Copy paste that. Okay, there's the other amount. Those should be the amounts. Yeah, it is. There we go. Has to be. All right, because those are the movements in terms of their equity that they're enjoying in the partnership. See, the valuation account has those balances. See, Eunice has even put a little note here. They probably have a working further down. Do they? Here's number one. Okay, they've apportioned it. Okay, they've done it differently. All right, I've done it this way. All right, I've used the journal entries and I've got the amounts and I've got it for each one. I've got it for K, I've got it for M, I've got it for L. Okay, because that's what we did. That's why I drew a picture. The picture was my answer. That's why I didn't have to do it again because I know I've done it. Okay, there was the adjustment. Okay, that was what K, M, and R is getting. They're getting an allocation of their capital. Does that make sense?
Yes.
Yeah, the diagrams are really good. I always draw diagrams, especially when you have these change in ownership type questions, because you can see the new, you can see the old, and then you can work out what you need to. Right, this is what I had to work out in terms of this. Those are my adjustments, or adjustments not the right word, those are my workings. Okay, those workings process those valuations, and you had given me those adjustments. So it just shows you can do the workings. Once you've got the workings, you've got to interpret the workings. K, there's K. I'm just adding and subtracting, adding and subtracting, adding and subtracting. Does that make sense?
Yeah.
All right, and then for the same thing for M and R. Okay. How are we feeling about this chapter? Not too bad, right?
Yeah, it's not too bad.
Ooh, hold on. Why do I have M here? I have R. Oh, I wrote K, M. Oh, I was supposed to write R. Sorry, I made a mistake here. There should have been R and M. I don't know where I got that
Oh,
other.
it was from the previous one with Lorato and
Oh, okay, maybe, yeah.
Mahatma.
All right, so K, R, and M. That's it, hey? Yeah. All right, so K
Yes.
is the right color. R, R needs to be green. Okay, and then M needs to be blue.
Blue.
Okay, just to make sure that that makes sense. All right, so yeah, you've got M, you've got M, you've got M, great. R, 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 great. Okay, that's right. And it's basically looking at that. Okay, so then all you literally need to do is just reference those amounts, okay, those workings, because remember, journals are posted to general ledger, right? And that's why
Yeah.
you've got the general ledger here. Oh, is that the end already? Yeah, that's the end, okay. And that's what they've posted. Okay, so you have general ledger workings. They've given you tier count workings. Okay, you could probably be given either or. We saw general ledger in the previous example. Here they gave you lots of those. Here, general ledger. And then here they gave you tier counts. Right? You can see that they like the valuation in terms of workings, okay, because they can give you either or. All right. I see the goodwill I've also got. There's the goodwill. Where's my goodwill? Where's it? Here at the bottom. Yes. Okay, debit the goodwill, credit K, credit R, credit M. Okay, see, K gets their goodwill. K gets a share. R gets a share. Mike gets a share. See that?
Yes.
Okay. All right. Is that all right?
Yes.
Okay, good. Okay, let's save that. Let's see if we can maybe just cover some theory. So I'm going to cover the theory in the next section. Maybe let's take a 5-minute breather just to relax a little bit. Take a bit of a pause because we've done a lot. Let me just see on that, not Excel, on my PowerPoint. I think I did cover all the PowerPoint here. Yeah, I did. Okay, the PowerPoint I covered here. The next chapter is, there should be liquidations. Yeah, liquidations I think is the last chapter for partnerships, if I'm remembering it right. Let's see. Yes. Okay. All right. So after next week, all the partnership stuff we've completed it, right? Because next week I'll obviously go through the workings, okay, the calculations in activity or unit 5. Right. Today I just want to wrap up this particular section by covering the PowerPoint presentation. Okay, just the notes. That's all. Okay, I'm not going to go through example activities. We can leave that for next week. Next week we can go through those. And then we can start with the theory for Unit 6. Unit 6 is an easy section. Some of it we already looked at today even, okay, when we spoke about the assignments. And then we've got companies isn't too bad. Branches is very short. Cash flows is long. Okay, cash flows is a difficult one. That one we'll spend quite some time going through. All right, let's have a look at theory. I'm just going to cover theory this week. We've got around, I think it's about 7 slides of content, and then we've covered the theory for this particular unit. The focus here in this set of notes is looking at a liquidation. What do you understand by the word liquidation? What comes to mind when you hear that word?
When you sell all your assets.
Okay, that's one way of looking at it. So liquidation, when you're looking at like insolvency, for example, businesses that are insolvent would go through a process of liquidation. That's correct. But when you're looking at a liquidation of a partnership, would the same thing apply? What do you think, Cheryl?
If you had to liquidate a partnership, yes, you'd
Okay,
still sell
so
all your assets.
we're actually looking at a dissolution. Right, so when a partnership is dissolved, What happens to these two partners if they decide to go their separate ways?
The business ends, or the partnership ends.
Good. Okay, so the first thing we need to remember, partnerships are not separate legal entities. If the one partner decides to leave, both partners have to go their separate ways. So if partners A and B have bought property, okay, let's say they've bought a building, okay, and they're running or operating from that building. Who gets the building?
Depending on the ratio, I guess, it'll be split.
Correct. Okay, a percentage of the building belongs to A and a percentage of the building belongs to B. If they agree that one of the partners can take the building, then obviously that'll affect the one partner's capital. Okay, because remember we said those partners are separate and they're recorded separately. So if A has capital in the business of maybe $1 million, and B has capital maybe 3 million. Right, if the property is worth $1 million, A or B could take it. But if they take the property, it's obviously going to affect their capital. Does that make sense?
Yes.
Right, when we're looking at a liquidation occurs when you have problems in the partnership because A and B might argue about the property. A might say, well, A wants the property. B might say, well, B wants the property. So what normally happens, okay, when you have a dispute, because disputes can occur in a partnership, often items are then sold off and the cash or the proceeds are then distributed to the partners according to a specific method. The method that Eunice is going to test you on is a loss absorption capacity method. Right, and that's something you'll see in one of your later slides. Okay, there's a piecemeal liquidation which has this as a consideration, and there's also a simultaneous liquidation. Those are the two types of liquidations that can occur when you look at a dissolution. Okay, where you dissolve a partnership. Right, we're looking at this liquidation, sequestration, insolvency. Right, so what will happen if a partnership is insolvent? What happens? What do you think will happen?
They sell off their assets to pay
Yes,
for
assets
the
must be
liability.
converted to cash. So in other words, there needs to be, it's almost like a realization. Remember when you have an asset disposal?
Yes.
Okay, and then you've got to work out the profit and the loss of the sale of the assets. Remember those concepts?
Yes.
Very, very, very similar to what you're going to look at here. Okay, you will also have a profit or loss on the sale of certain assets. Right, but what's important is when you have a liquidation, who gets paid first? Do the partners get paid first or do the creditors get paid first?
The creditors.
Very important, yes. And that you might have covered in law, okay, in insolvency and that type of thing. Right, creditors, in other words, the liabilities. Liabilities have to be settled first before any of the partners can get paid out. Right, and the reason for that is because, remember we spoke about the theory, we said partners have unlimited liability. What does that mean?
That if the business is bankrupt or their liabilities is more than their assets, then the bank or the creditors are allowed to touch the partner's personal belongings or
Very good.
money.
Okay, perfect. Your theory is very good. You understand the background regarding partnerships, and that applies here as well. Right, so you cannot pay any cash to any partner. So for example, that example we had earlier here, okay, let's assume the building was worth $1 million, okay, but you had liabilities in the partnership of 10 million. Okay, can I give the building to the partners? No. Okay, because you have outstanding debts that need to be settled first. So you cannot pay any compensation or any cash to the partners before you've settled the outstanding debts of the business because of what you've identified. Unlimited liability, very important consideration when you get into a partnership. Two types of liquidations. Both are covered in in INV, not INV, FAC 1601. The first, simultaneous liquidation. The second, piecemeal. Quite easy to remember. Simultaneous means everything is sold off at once. A nice way of looking at it, it's like a garage sale. Okay, where you put everything out, whatever sells, sells, whatever doesn't sell gets thrown away, basically. Okay, so everything has to go. And it can be sold at less than its market value or its fair value. And that can be a consideration. Right, so when you have a simultaneous liquidation, this is when you have a partnership that is, so the two partners, they can't wait to separate. Okay, it's like a marriage that has gone very bad, right? And those people just want to get out of the marriage as soon as possible, right? That would be a simultaneous liquidation. Sell everything, whatever we get, and then we part ways, basically. Right? Does that make sense?
Yes.
Okay, when you do a simultaneous liquidation, you're only going to have a liquidation account. Here's another working account. Working accounts don't have balances. Working accounts close themselves off. And you will also have bank and you will have capital accounts. Right, why capital? We spoke about this in a previous week. Capital represents the entitlement of those individual partners based on their long-term investment in that particular business. Happy with that?
Yes.
Good. Okay, bank is important as well because cash will be realized from those assets. And then the other type of liquidation, piecemeal. Piecemeal says you have different stages when you sell off those assets. So we're not going to be hasty and we're going to sell off all those assets at a loss. We're going to wait and we're going to sell those assets when we believe we can generate the most from those assets. Because maybe the market's not so well, maybe the market's not doing so well, and it's not a advantage, okay, to offload or to sell assets at the moment, right? And that you do using a table method, where you'll have columns and you'll process the liquidation according to columns. If you've gone through the assignment 1, you would have seen I would have drawn columns, and that was a piecemeal question, okay? And you'll learn how to do that over the next few weeks, okay? All right, just a note about simultaneous. There's a few steps here that you can consider when approaching a question, just to highlight some of the important points. Trading is discontinued. If it's discontinued, that means there's no profit and loss. There's no income and expenses. Right, you literally close off all the balances. And then you've only got balances that are open for liquidation. And you'll have a liquidation account. Right, so just keep it simple. Don't overthink it. Simultaneous means sell everything, get as much as you can for it, and then pay out the partners. Step number 1, close off the drawings, close off the current. Where do you close it off? Always to capital. Remember, capital is important, bank is important, and obviously liquidation is important. Okay, those are the tier accounts that you're going to have in this type of question. Right, goodwill. Let me ask you about goodwill. What is goodwill? Do you remember?
The reputation.
Very good. Right, so if the partnership is going to be liquidated, can I sell someone my goodwill?
No.
No, you can't. All right, so goodwill is great when you're operating as a going concern. Goodwill is bad if you're going to be liquidated because the business will stop operating. Right, remember we said there's no separate legal entity. Goodwill will only exist if you have a business that's continuing to operate. And we saw in the previous study unit guide, or this previous study unit in the study guide, we saw goodwill being calculated based on the 1/6 that was being paid for part of the business. Right, so when goodwill gets written off, how do you close off goodwill? How do you close off an asset?
You'd credit it.
Yes, you would credit the goodwill. So what's going to happen to the capital accounts?
It will decrease.
Yes, very good. Okay, so you can see goodwill is a benefit when you continue to operate. but goodwill is actually to the detriment of those partners because goodwill will negatively affect your capital. Happy with that?
Okay. Yes.
Okay, same with the reserves, same with the cash, and same with all the assets. Okay, everything is closed off. Right, this step takes the longest to do because it all depends on how many assets and liabilities you've got. Okay, if you've got lots of assets and liabilities, you've got to close each and every one of them off to the liquidation account. Right, the liquidation account is just one big T account, and we'll look at that when we get to the practical questions next week. The last step is the closing off, okay, where you literally settle the outstanding capital accounts of the partners that have credit balances. Only partners with a credit balance will get paid out something. Right, the partners that owe would obviously have to compensate and pay back the partnership for excessively drawing from the partnership. Right, it all depends. Okay, we'll see different scenarios later on. Right, here's a note about the liquidation account. This is what it looks like. It's a working account. Okay, you're never ever going to see a balance on this account. This account will always close itself off. So you'll basically put totals here. Okay, a total there, and then you will have a balancing figure that'll be closed off either to capital or, well, when I say to capital, it'll be closed off to capital either as a profit or as a loss. Right, so if you look at this T account, okay, if I'm debiting the liquidation, here's the debit. If I'm debiting the liquidation, what am I going to do to the capital?
Credit it.
I'm going to credit the capital. Well done. Right, and if you're crediting capital, is the entitlement going up or down?
Up.
It's going up. So what do you have here? You have a profit that's going to be transferred to the partners. Right, and the same on the right, if you have a credit, if I'm crediting the liquidation, okay, I'm going to debit the capital. Right, so if I have a balancing figure on this side, it's seen as a loss. If I have a balancing figure on this side, it's seen as a profit. Okay, that's something you can study and you can note, but we'll see examples and you'll kind of get comfortable doing it. But I like to think about it in terms of debits and credits because it's the easiest way to approach it, and then you'll know whether there's a profit or loss. Just think about the impact that this will have on the capital accounts of the partners. That's all you've got to do. Okay. Right, we've got one more slide, two more slides actually, and then we're done. On this slide, I've got a note here about the piecemeal liquidation. This is an important one. This I've seen quite often in terms of past papers. They like it. We saw it in the past, the assignment. Okay, the one that we had looked at in the first few weeks. Okay, assignment number 1. The piecemeal liquidation, because you've got the word piece, think about different stages. Right, so if we've got assets, okay, right, and we're selling those assets. Right, those assets are going to be sold in stages. Right, maybe we sell the house first. Right, then we sell the factory. Okay, then we sell the vehicles and machinery and so on. Right, at each point in time. So when you have stage 1, okay, then stage 2, and then stage 3. At every stage, you need to consider whether there is capital or cash, I should say, that's available to be disposed of, and can it meet, okay, the liabilities. Right, remember we said earlier, who gets paid out first? The creditors, always. Right, so when you're looking at a piecemeal liquidation, you'll see the steps are the same up until this step. This is the same as before. So it doesn't matter what method. If it's simultaneous or if it's piecemeal, you still have to close off drawings and current. You still have to close off goodwill and reserve. The difference is here. Right, on this slide, you had liquidation account. Everything goes to the liquidation account. On this slide, you've got the record of the payment of expenses, the settlement of liabilities, the receipts, and the interim payments. But all of this is done in a table. And that's what I'm going to show you when we look at those practical examples. Right, so you're going to draw up a table to process step number 3. You're not going to have a T account. all of it gets done in columns, and then you go through it row by row, stage by stage. And then ultimately, once you reach the end of the liquidation, again, if there is any amounts left over, then you will settle and you'll pay out a portion to those different individuals, okay, the partners. All right, here's the last slide, piecemeal liquidation. This is describing the method. There is another method in the textbook. If you've got the textbook, they talk about, I forget the name, I think it's a surplus something, a something surplus method. I forget the full name. I'm going to have to go find the textbook in the bookshelf again to look at it. But you don't get tested on that method. So you just have to worry about this one, that's all. Loss absorption. And this method is actually the best because it's the most, inverted commas, practical. Right. And you'll see it's very simple, but it's simple only if you understand what we spoke about earlier today. Remember we drew up those columns where we had owner's equity, assets and liabilities, and we were keeping track of the owner's equity equaling the assets and liabilities. Remember that?
Yeah. Yes.
Yeah, we're going to use that a lot when we look at the loss absorption capacity method. Right, it's important to understand the theory because once you've got the theory, then you can apply it quite easily. Just to give you the context, if you summarize this section, piecemeal liquidation, loss absorption capacity method, okay, interim payments of available cash are only going to be absorbed or paid out to those partners that have a favorable capital balance. Right, so in other words, the textbook talks about a maximum anticipated loss. Right, so when we spoke about owner's equity equaling the assets minus the liabilities, remember we said owners are entitled to the assets and the liabilities. When you're looking at piecemeal liquidation, what you're saying is, let's assume that our assets are worth nothing. In other words, maximum loss. If we have zero as a loss, if we have nothing in terms of value and we have zero to distribute, okay, maximum loss. Which owners are still favorable in terms of their balances? Which owners still have a credit balance? Do you agree if those owners still have a credit balance, then the cash needs to be given to those partners? Does that make sense?
Could you say that again, please?
Okay, so what we're saying when we're looking at a piecemeal liquidation, looking at a loss absorption capacity method, okay, let's assume we have the house, okay, and we have the car, okay, and you have partner A and partner B, okay? Partner A and partner B, do you agree they're in a partnership? All the assets belong to A and B, and let's assume it's 50-50. Does that make sense so far?
Yes.
Okay. Let's assume that A and B are able to sell the car and they can get R1 million cash for that vehicle. Okay?
Okay.
The house still needs to be sold and the house is worth 3 million. Okay? If you're looking at this scenario, right, do you agree in terms of owner's equity, A and B have 4 million rand equity in the business? Does that make sense?
Yes.
You've got the house and you've got the car, assuming you don't have any liabilities. Okay. What loss absorption capacity method says is assume a maximum anticipated loss. So in other words, let me change color quickly. When you look at the LACM method, okay, what the method says is ignore the house. Assume you made a loss. Assume you're not going to get anything for the house. And you've only got R1 million left in terms of cash. Okay? Who gets the R1 million? Right. Assuming A was an irresponsible partner. Assuming A only had 500,000 in terms of capital. And assuming B had 3.5 million in terms of capital. If I have a maximum anticipated loss, in other words, if I don't get anything for that house, okay, obviously A is going to be in a negative position, right? Because that house was worth 3 million. So minus 1.5 minus 1.5. Okay, what am I going to get there? I'm going to have minus 1.5 here. I'm going to get minus 1 here. And I'm going to have plus 2 there. Do you see that?
Yes.
Okay, remember, A and B are partners. So A and B are jointly and severally liable for the assets of the business. So B is going to have to take on A's debt. A is basically going to affect B in terms of their compensation. So if I minus that million from B, I'm going to get 1 million left over. Right, so who is entitled to something? Should I give A anything? No, I shouldn't. Should I give B something? Yes, I should. Because B still has capital, even though we assumed a maximum anticipated loss. Right, and that's the principle. The principle is what I've described now. Okay, take the assets, assume you can't sell the other assets, and I've only got the one, and I've got the cash. Okay, who basically gets the cash? It's the owners that still have credits on their capital accounts. In other words, the owners with the responsible capital balances, basically. Okay, does it make sense?
Yes.
Perfect. All right. I will discuss it and go through it again when we look at practical examples, and we'll discuss it and look at it in detail. Okay, just to end off, I've just given you some steps here. Follow the steps if you want to just follow a nice, easy way of doing it. As long as you cover all of the steps, you're okay. Right, when you look at a piecemeal liquidation, just remember we need to close off those accounts. So the first step is obviously to close off everything to capital. Okay, we saw that on the previous two slides when we had piecemeal and simultaneous. You always have to close off goodwill, you have to close off capital, you have to close off current account actually, you have to close off current account to capital, you have to close off drawings to capital, reserves to capital, and which one did I miss? Oh, the goodwill. Okay, there's 4 of them. Goodwill, current account, reserves, and goodwill, capital, current account. Oh, and drawings. There we go. Those are the 4. All right, so that's what you need to look at. And then once you've done that, you need to go step by step, close off the unsold assets, sell off assets, close off those assets, and then keep selling assets until you reach the end. Okay, so it's a step-by-step process. It's quite simple to do. Once you get the hang of it, it's quite simple. And that's it. That was the last slide. Okay. All right, Cheryl, quite a long session. Hopefully you're still okay.
Yes.
Perfect. All right. Is the 3 hours okay for you? Can you go the distance? Are you all right with the length?
Yeah, I'm okay with the length.
You sure? All right, because if you do need a break in between, just let me know, and then we can always make a plan. Okay.
Okay.
All right. Okay, Cheryl. So for next week, just have a look at the theory that we've covered so far in those other examples. You can maybe go back and see if you can try do some of them in terms of those tier counts, just to practice what we've covered so far. As I said before, if you can just keep up to date week on week, you'll be fine. By the time we get to past papers, then we can obviously revise as we go. Okay, so when I do a question, I'll do some revision and then cover it. I'll do a question, cover revision, and then look at the answer and that type of thing. All right, so we'll get there. We've got lots of time actually, which is good because the sooner we get to past papers, the better. But I don't want to rush the theory either. I want you to understand all the sections so that you have the knowledge and you have the content, and then we can just build on it later on. Okay. Okay, perfect. All right, Cheryl, I'm going to say goodbye. Have a good week. Take care, stay safe, and then we'll meet again next week. I will send through the rest of that assignment. So just keep checking your email. I'll probably try to do it later today if it's not too busy, or tomorrow. And at least you have those answers that you can use for your assignment submission. Okay.
Okay. Thank you so much.